like Japan. And then within the commodity space, we like energy, we like industrials, we like precious metals. Commodities we think are really the next thing. And they're breaking out. Again, within the last 2 weeks, WTI has broken out. Goldman Sachs Commodity Index has broken out. And that's telling you that we're not going to have a recession. So bonds priced out recession first by getting rid of the rate cut for next year. For this year, second half of this year. Then stocks with the move into cyclicals, and now commodities are pricing out recession. So you're not going to have a breakout in commodities in a recession, right? Those two things don't go together.
Jay, this would have been easier if we just started the interview by saying, what don't you like? You know, this would have lasted 30 seconds. Jay, it's good to hear from you. We've got to let you go.
He doesn't want
Jay
to
Pulaski.
go. He'll come back.
Let me tell you
exactly.
what I don't like. You. We get along, don't worry. 7:30 a.m., 20 minutes away. Tony Rodriguez and Nuveen on Fixed Income from New York City this morning. Good morning.
Three prime ministers, 4 chancellors, an energy crisis and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. Earnings season is here.
Decent start to earnings season.
We are heading into the meat of earnings season.
Bloomberg breaks the numbers first.
We have Bank America, we have Charles Schwab.
Tesla, Netflix, you name it.
They're heading in the right direction.
A record quarter of revenue.
With exclusive expert analysis.
What do they have to deliver to justify the rally we have seen?
Earnings are still going to be under pressure.
Is there a divergence that's really important to draw here?
The massive divide between Diamond and Fraser.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
There's concerns about your Democratic colleague, Dianne Feinstein, as well. Is it time for many of these individuals potentially to step aside and make way for a new generation of leaders?
Look, they'll have to make that decision themselves, but members ought to be able to do their jobs. Members ought to be in a place where they can perform the duties and responsibilities given to them by their constituents. And I'm hopeful that both of those individuals make the decision based upon that criteria.
Steny Hoyer there of Maryland, the Democratic congressman. Speaking of Bloomberg's Anne-Marie, we'll catch up with AMH in just a moment. Live from New York City this morning. Good morning. Plenty of feedback about Jay Pulaski and his optimism. That feedback is welcome. Your equity market on the S&P 500 positive by 0.5%. Yields are lower this morning by 4 basis points to 395.66. Taking back some of the move from yesterday, Lisa. Yields much higher, of course, off the back of stronger than expected US data and a suggestion that we'd get a yield curve control shift from the BOJ. And this morning, that's what we got.
Haven't you been a little bit surprised that all of the strategic ambiguity, I'm going to keep cannibalizing this word, this this phrase hasn't created more volatility, given the fact that we could be nearing the end or the beginning, and depending on which region you're in, of some very new cycle?
I'm going to borrow someone else's phrase.
Okay.
Used to get these financial stability reports from the Bank of International Settlements, and they're always pretty bearish, actually, on global markets.
Oh, I know. I love reading them.
Do you remember them
Yeah.
in the old days when rates were too low and all of that good stuff? And I remember this phrase in there, an uncomfortable calm. There's an uncomfortable calm right now going through the summer. There's this belief that we can get the optimal outcome, the soft landing. That belief is not shared by everyone, but even the people who don't think that materializes thinks that the data will carry on looking that way this summer. And I think that underpins this uncomfortable calm right now. Can you really extrapolate out current conditions 3 months, 6 months into next year?
And it's an uncomfortable calm because it's very difficult to be bearish after being so wrong about being bearish during the first 6 months. And it's difficult to be bullish after the gains that you've seen. And so you just kind of sit in there waiting to understand which direction we're going in from data that may or may not show it soon enough, whether or not you believe that the year-over-year comps can really provide that true read.
It's far more uncomfortable if you've missed out the 40% move
Whatever.
in the Nasdaq 100. Anne-Marie joins us now down in Washington, D.C., AMH, our chief Washington correspondent. Anne-Marie, you know where the conversation's been in Washington in the last 24 hours. It's an aging Senate and more, I would say, upsetting pictures coming from Washington, this time of Dianne Feinstein. Can you tell us what you're learning about the future of some of these policymakers?
Well, actually, Jonathan, today in the Washington Post, the data they have is that in terms of incumbent legislators in Congress, this is the oldest we have seen of a class. So, of course, there was the concerns about Senate Minority Leader of the Republican side, Mitch McConnell, when he froze on camera for about 20 seconds. And then yesterday, Dianne Feinstein, who is newly back in the Senate, remember she had taken some time off to recover from shingles, she seemed confused in an Appropriations Committee, and she looked down to start giving a speech, but really she only had to vote aye or nay, and then she was prodded to just vote. She did it, and then she was told by the senator next to her, just say aye. So she was very confused, it looked like, in this moment, and then she was basically told on camera with a hot mic how to vote. So this just raises fresh concerns over whether or not these individuals at the moment are fit to do their job.
Wasn't it Nikki Haley early this year who raised the proposition, or at least offered the idea, that perhaps we should have competency tests for people in Washington, D.C.?
Yes. Also, Jonathan, when you look at some of the data in terms of the polling, many people want to see term limits for these congressional leaders. Others want to see, if there's not going to be term limits for some of them, they want to see upper age limits on them. Now, we should note, a lot of Americans think if you are 70s or 80s, but you have the mental capacity and you are fit to serve, then you should be able to do so. And you probably bring a great deal of knowledge. You are very wise to the legislature. But if you are not, they definitely want to see something happen where we are not in this position where individuals potentially are concerned or confused about where they are, and they're supposed to be legislating on behalf of the American people.
And ran a much more practical and near-term consideration. Mitch McConnell's future is really a question mark at this point, with even some in the Republican Party wondering who could follow him as the GOP minority leader in the Senate. Some people pointing at Senator John Thune of South Dakota as the likely successor. What's the latest on that?
It'll likely be an individual named John. There's about 3 senators with the name of John that could potentially take on this role. John Thune, John Cornyn. They are likely potentially to be the next successor for the senator. Obviously, anything can happen. Nothing is set in stone, but these are part of his leadership team now on the Republican side, and they could potentially take the reins. But we should note Mitch McConnell, and everyone has come out, and he's come out and talked to reporters, and he seemed fine. He wants to remain where he is at the moment. And I thought he had a very good politically astute moment when he went back out and spoke to reporters and said, actually, the President of the United States called me, Joe Biden, and I just told him I got sandbagged. So he immediately reminded reporters on the other side of the aisle there also are individuals that people are questioning about their age. And obviously he was talking about the president who tripped over a sandbag earlier this year.
Look, and this is an issue on all sides, and it's not a partisan issue. It shouldn't be a partisan issue. There's a real question about just generally the composition of the legislature. There's also a question, Anne-Marie, about who the leaders will be at the top of both parties. If there is some sort of turnover, does the balance move more to the fringes, or does it move more to the center? Is there an idea, as there is discussion about new leadership?
Well, that's a great question. I think it truly depends. I mean, a lot of this depends on what congressional district you're looking at. A lot of this depends on what state you're looking at and the Senate race it is. And then also it comes down as well on the presidential level. There's a lot of concerns as we gear up for 2024 and that November presidential election about the age of right now who would be the top candidates on both sides, the nominees, about both their age. It's not just that the president is in his 80s and at the end of a second term he'd be 86, but it's also the fact that many think the former president, Donald Trump, besides the fact is he is dealing with a tremendous amount of legal issues, he is in his late 70s, and many would say that he's an unhealthy man as well. So this is by and large a huge problem on both sides of the aisle. But likely, if you're going to see a new generation of leaders, potentially it goes to what many would call the boomers, I guess those in their 60s, and then much lower, 40s, 50s. And you're seeing them emerge on both sides, but they're not at the top level just yet.
Can we talk about the latest indictment for the former president? Anne-Marie, what have we learned?
Well, the latest indictment, Jonathan, is that the president now has fresh charges against him in the documents case. So everyone yesterday was waiting on the indictment about overturning of the 2020 election results, the January 6th indictment. Trump's lawyers were at the DOJ yesterday, but that never came. What we have are fresh charges when it comes to the documents case that's being prosecuted now outside the Southern District of Florida. And this is two issues in this case, this latest indictment charges. One is that Trump wanted to amend to get rid of surveillance footage. And there's a third defendant that is charged in this case as well, another worker at Mar-a-Lago. The second is that he wanted to conceal a willful retention of national security documents. Now, remember, there was a leaked audio about this and a conversation in Bedminster, his golf course in New Jersey, about a very sensitive document about the U.S. potential military plan in another country. These are the two latest charges in that same case in Florida. This is the documents case.
What a bizarre time it is down in Washington. Anne-Marie, thank you. AMH in Washington, D.C. on the latest. If you are just tuning in, welcome to the program. As we get you towards the weekend, your equity market with a lift, 0.5% higher on the S&P 500. This from Apollo and Torsten Slok this morning. In sum, for markets to continue to trade higher, the soft landing must be a soft landing, not a reacceleration. Because if housing and consumer spending accelerate from here, the Fed will have to raise rates a lot more. That just in from Torsten. We'll pick up on that in a moment. Tony Rodriguez and Nuveen up next.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
The names that move markets are on Bloomberg.
Concentration in industry after industry after industry is a threat to our economy. It is a threat to innovation, and ultimately often leads to price gouging, whether it's consumers or the government. I believe in the power of markets, but they only work if we enforce the rules that keep competitors going rather than monopolists.
Nobody covers business like Bloomberg, your global business authority.
Equities with a lift this Friday morning. Good morning to you. Going towards the weekend with equities positive on the S&P 500 by 0.5%. On the Nasdaq up by 0.9%. The Nasdaq has looked pretty good, hasn't it, all year? It's been backed up by the earnings we've had so far this week. From Google, from Facebook. The Russell of small caps positive too by 0.55%. In the bond market, 2-year, 10-year, 30-year. Yesterday, Treasuries lower. The data pretty decent. This morning, Treasuries rally, yields are lower by 4 basis points, 395.66 on a 2-year, down 6 basis points to 486.82. 2 CPI prints between now and the next meeting. The first one, August 10th. The next one, September 13th. The next Federal Reserve meeting, September 20th. And Jackson Hole, back end of August, I believe, 24th to 26th of August. Unclear, always is, Lisa. We often talk about this. Chairman Powell's going to deliver a speech. I mean, he might do. It's unclear as to whether he will do.
Wait, are you saying, and you made the suggestion yesterday too, maybe he just doesn't show up.
Maybe he won't.
Maybe he just takes August off. I mean, strategic ambiguity is strategic absence as well.
Exactly.
Hello, summer.
Hello, summer. Take a break. After the financial crisis, there became this almost expectation that we would always get the speech from the Federal Reserve Chair at Jackson Hole. We probably will. I'm just saying, you know, maybe we won't.
And maybe it'll be 6 minutes. Maybe it'll be 4 minutes. I think the issue is, if he does give a speech, what can he say if he basically said nothing at the press conference by design? If he's herding cats of different philosophies economically and looking at data that could tell you 5 different stories depending on how you wanted to read it.
And by herding cats, you mean the people on the committee right now on the FOMC.
Exactly, yes.
Given the difference in views at the Federal Reserve at the moment. Chairman Powell expected to deliver a speech at Jackson Hole. We'll see if he does or doesn't. Mike McKee will be the first one to tell us, no doubt. Let's turn to foreign exchange, to the euro. The euro this morning just in and around 110, 110.14, turning positive in the last, I would say, 20 minutes or so. We're positive there by 1/3 of 1%. Under surveillance this morning, your top story, the BOJ rounding out the week of central bank decisions with a surprise easing of what they call in Japan yield curve control. The governor of the Bank of Japan keeping the target for the 10-year yield at around 0%, but this 0.5% ceiling is now being called a reference point and not a rigid limit. Read between the lines. The governor's saying this isn't a step towards normalization. We're still far from where we can raise short-term interest rates. So clearly, we don't want to talk about raising rates, Bramo, but ultimately, there's a shift in the tolerance around the ceiling for a 10-year yield in Japan.
When we got the rumor of some shift yesterday from the Nikkei reporting, the market was concerned, and you could feel this. It was a pretty significant holdup. What do you mean? Nobody's expecting this. What are you going to say? And then he comes out and he says, I don't know, what did he say? He said, basically, we're not doing something, but we are, and you know, we're always going to be data dependent. And here we are with relative calm. And to me, how much freedom does that give them to move further, to make further adjustments, given the calm that we've seen certainly today?
Huge if, and I know we're both on the same page, if it continues. Sure. If that calm continues, and so far, so good. In Europe, fresh data out of the Eurozone showing Germany just about exited this winter recession it's been in for the last couple of quarters. Output stagnated. So that's the win. The good news, they're no longer in recession. The bad news is that output stagnated. GDP unchanged for the previous 3 months. We were hoping, and I say hope, Lisa, this is what hope is in Europe for Germany at the moment. We were hoping for 0.1% growth, according to estimates.
We still have projections by global bodies that Germany will be the only developed economy that will be in recession this year. They are expected to be in recession for the full year at a time when previously it was thought they hinged on exports that go over to China. Is this still a China story, or is there something else going on structurally with the biggest economy in Europe that creates a real challenge, especially with monetary policy, but also for the overall getting out of inflation without stagflation that really could be pernicious?
It's a struggle. So that's the latest from Europe. Here's the latest from P&G, Procter & Gamble. What do you do if volume is down? How do you achieve revenue growth? Well, you put prices up, don't you? And that's what they've been doing. And they've got the pricing power to do it. Let's be clear about it. P&G this morning up by 1.7%. We've seen it from Procter & Gamble. Lisa, beat on the top and bottom line from P&G this morning. And pricing power is back. And it looks like the consumer is still tolerating it.
Have you ever bought Tide Pods?
I've got Tide Pods, yeah.
Me too. They're pretty expensive. And actually, if you go into...
You don't do them on Prime Day. Do them on Prime Day.
You load up? Where do you store them? In New York City apartments? Where do you store them?
We've got storage.
You've got storage.
We've
okay,
got storage.
Well, I will just say that in the local drugstore, they're locked up now currently because they are that valuable, and the Tide Pods are pretty expensive. My point here is they do have pricing power, and you see gross margins increasing, especially as input prices come down. So they aren't having to spend as much to make said Tide Pods, but they still cost.
I have the luxury of having the washing machine and dryer in the apartment, which is, I know it's a luxury for Manhattan. If you're sitting here in the United Kingdom or elsewhere, yes, truly, that is a luxury for a New York apartment to have a washing machine and a dryer in the apartment. And then I pile up the Tide Pods down the side in that little cupboard thing. Just
That's so in character.
You don't buy them in bulk?
Perfectly. I do buy them in bulk, but so you just have them like stacked up perfectly?
Individually, and take out the pods and just put them. No, of course
it's like
I don't.
Building blocks.
Ramos, stop it. Tony Rodriguez joins us now, head of fixed income strategy over at Nuveen. Tony, we're not going to talk about Tide. We'll talk about the BOJ. What have we just unleashed at the Bank of Japan this morning?
Well, good morning, Jonathan. Good to be with you. So I think with the BOJ, the market's surprised by a bit. I think everyone expected that yield curve control would be addressed probably more in the fall. So they maybe done it a bit early, but they certainly did it in a bit of an ambiguous way with putting maybe this 1% ceiling, but it's a reference rate at 50. Our view is that 10-year JGBs, probably fair value, are in the 75 to 85 basis point area. So we think that 1% ceiling is one that wouldn't be hit anyway if they completely loosen yield curve control. So I think this is a small step ultimately in the direction of having a firm ceiling, probably at 1%. But given the conditions of the Japanese economy, although inflation is certainly, stronger now than it's been any time in the last 30 to 40 years in Japan, we don't think it's going to be at elevated enough levels, and growth will not be significantly strong enough to really drive 10-year JGB yields significantly higher than where we are right now.
Tony, 25 basis points in a place like Japan and the Japanese government bond market isn't nothing, it's something. Can you tell me how you'd expect domestic investors to reallocate away from international stories, perhaps bringing money back home?
I think you're going to see a modest amount of reallocation, but at the end of the day, you're still seeing significantly higher yields abroad. As long as hedging costs eventually begin to decline, because those have been quite stubborn. We've seen hedging costs for the euro decline pretty dramatically from peaks that we saw last year, whereas yen hedging costs have stayed very high. If those begin to ease, I think, again, you will see some reallocation, but we don't think it's going to be seismic by any means. So ultimately, it's going to be about, hey, what's the best total return value you can find across broad capital markets for a yen-based investor? And in that equation, we still think areas outside of Japan are going to remain pretty attractive for the Japanese investor.
Taking a step back, the era of forward guidance seemed to have died this week, both from the Fed and the ECB, on some levels the Bank of Japan as well. Where does that leave you? How does that shift your view going out about a gradual move lower in U.S. yields and just a gradual lean into duration?
Well, Lisa, it's tough to have forward guidance when you don't have any idea where things are going. And certainly central banks have had difficulty forecasting where we're heading. from our perspective, really the key driver about where monetary policy is going, certainly in the U.S., but also abroad, is obviously the inflation metrics and the underlying economic strength. And from that perspective, we do think you're going to continue to see improvement on the inflation story, but not significant enough improvement that's going to allow central banks to say mission accomplished. The big issue is on the growth side. And while growth has surprised to the upside in the U.S. and kind of globally, we would argue, we think that's just merely a delay in what's ultimately going to be slowing economic growth. If we take the U.S. as an example, it's certainly been more resilient, whether it's because of the CHIPS Act and infrastructure spending on the fiscal side, whether it's because of the consumer being more resilient due to a very strong labor market and excess savings. As we look forward, we think that those excess savings are basically spent. You're hearing that from many of the banks in their earnings calls, that consumer balances are back to where we were pre-pandemic. So that will no longer be a support. When you look at the manufacturing sector, we're seeing some modest slowing there. So our view is that you're going to see a slowdown in the second half, ultimately potentially a very mild recession early in 2024. So it may look like a soft landing or feel like a soft landing in terms of not seeing a significant rising unemployment rate, but it will be enough economic weakness to allow market yields to decline from where we are today, both in the U.S. and we think abroad.
How have you shifted your stance as the economic data has come in stronger than expected, given that so many people are pushing out their expectations for recession, if we even get one?
Yeah, so the big shift that we've seen really is that we've grown much more comfortable with duration risk. Anytime we see the 10-year above 4%, we think that's an attractive area to add duration to portfolios. We ultimately think high-quality duration is going to be a very good hedge if in case we're wrong and it's a more severe downturn than just a mild recession / soft landing next year. That long, high-quality duration is going to be really a very attractive hedge versus risk assets. At the same time, as we sit here this summer, given where risk premiums have gone, spreads have tightened, the attractiveness of the credit sectors has certainly declined a bit. So we are actually kind of reducing our exposure there, thinking that there'll be some better entry points as we move through the year. So we're moving closer to what we would call the midpoint of our risk budget here and staying up in quality to reflect that slowing in economic growth that we're expecting, some increase in defaults as we move through the balance of this year in our portfolios.
Interesting. Tony, thank you, sir. Tony Rodriguez there of Nuveen on the credit market. I had this conversation with Peter Cheer yesterday, and I wish Pete was on a panel with Tony because Peter Cheer thinks we're in the summer sweet spot, thinks the juice is worth the squeeze, maybe take on a little bit more risk through the rest of this summer. And then you've got Tony Rodriguez talking about the same sweet spot, but ultimately using it as an opportunity to trim risk and prepare for opportunities later this year.
Get the outcome right, and you'll still get two different trades. And I think that's a great way of putting just the uncertainty, not only in what's going to happen, but how you play it out through markets that have really defied logic in some capacities, or at least traditional. So.
How do you feel about the BOJ this morning? Starting gun on tightening or just making easing more sustainable?
Both, right? Because they're making easing more sustainable by relaxing their hold just a bit. How much of what we saw from the Fed and the ECB gave them the license to do this? Because you had a less aggressive policy there, it would be less disruptive for them to make some sort of shift. And maybe that's why they saw an opening this week.
If they made the move when government bonds were selling off aggressively and the tightening cycles had just started from the ECB and the Fed. It's an interesting point. Live from New York City this morning. Good morning. Welcome to the program. On the S&P 500, we are positive by 0.5%. Coming up a little bit later, 8:30 a.m. Eastern Time, so about 40 minutes from now, Jonathan Pingle, the chief U.S. economist at UBS, to break down the strong data we've seen so far this week. And Lisa, more data still to come later this morning.
You know, here's the issue, and I've really been confused about this week. What data is going to matter? How do we translate it? Is it going to be Procter & Gamble showing that they can raise prices? Is it the fact that NASDAQ 100 companies are no longer mentioning recession? They're all mentioning artificial intelligence and the boom that it's going to create for their earnings and pricing power. Or are we going to look at these lagging indicators that have proved faulty in the past, right? I mean, at what point, what is the actual indicator that's going to give us a sense of what direction central banks are going to move in?
You get a break in the Goldilocks story. Max Kentner of HSBC has been tremendous, hasn't he, over the last 18 months? And Max talks about that Goldilocks moment where the economy's not too hot, it's just right, just encouraging this idea of a soft landing. But to Torsten Slok's point this morning at Apollo, for markets to get that ultimate nirvana outcome, you don't want a reacceleration. And we're seeing in certain parts of this economy a reacceleration.
The housing market, to me, is the key right now also, because you do see a bottoming out and a reacceleration in that area. And if that is the leading indicator in terms of interest rate sensitive sectors, what's that saying about supply and demand, about price tolerance, about the efficaciousness of the idea of a 7% mortgage rate? Nah, who cares if no one's paying it?
We've got to talk about this FX market as well. Jane Foley of Rabobank joining us in about 5 minutes' time. Really looking forward to catching up with Jane after the moves we've seen from the Bank of Japan this week, together with the ECB and the Federal Reserve. To the heart of foreign exchange very shortly from New York City. Good morning.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
The names that move markets are on Bloomberg.
China has seen slower growth than they expected. Many countries do depend on strong Chinese growth to promote growth in their own economies. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think we're in a good path.
Nobody covers business like Bloomberg, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally. We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
They don't think they've beaten disinflation. They don't think they've got growth. You know, they've moved up short-term inflation forecast, left the long-term ones.
So is this not a step towards normalization then, as no, he said it wasn't?
It isn't really. Well, it's an indication that they know that yield curve control is a bad policy that needs to go, and it's an indication that they're cognizant of the fact that actually the economy is doing better than it was. It'll take months to get the next move. Ultimately, yield curve control is a terrible policy.
What said Kit Jukes, the head of FX strategy over at SocGen, catching up with Danny Berger on Bloomberg. The early edition, a little bit earlier on this morning. Looking at the FX market, dollar-yen is lower for 5 consecutive sessions every day so far this week. Yen strength against the US dollar. On the week, that currency pair is negative about 1.85%. So tons of yen strength out there off the back of this move from the BOJ, loosening its grip on bond yields. Jane Foley of Rabobank saying this, that the BOJ tweaked YCC in, quote, a very cautious way. As expected, the BOJ raised its 2023 inflation forecast, but there was no upward revision to core CPI in 24 or 25. Therein lies the reason for continued caution from the Bank of Japan. If further progress is made in reviving domestically driven inflation, the BOJ will act again, but they are clearly in no rush. So, Jane, we've got to start with that question. Lisa's asked it a few times, and Danny Berger asked it again this morning. And, Jane, thanks for being with us. Is this the starting gun on tightening, or just setting up policy to keep things a little bit more sustainable and easier for longer?
You know, the starting gun really reminds me of the tortoise and the hare, and I think the
Bank of Japan really is the tortoise in this race. It is going to be in no rush. And this is, backing away from yield curve control, because it can be a nuisance sort of policy. It can push policymakers into corners. And we had this in December when the Bank of Japan, made an adjustment to the range for the 10-year yield and said it was an adjustment. Now, clearly, we could see those distortions. You have the possibility where you have maybe 5-year yields, 7-year yields rising above the 10-year yield. That's not what they want to signal. So they had to raise the parameters. And really, I think there's something about what's happened today, which is the same. They want to take themselves away from being pushed into a corner by market conditions and hence the loosening. But on the other hand, if you read through a lot of the rhetoric from some of the Bank of Japan policymakers, some of them are clearly seeing these signs that inflationary conditions are just beginning to normalize. And I would say perhaps, the real piece of juicy news from Japan, this week is that the government looks likely to be recommending another hike in the minimum wages. That would be a 4% hike. There was already, a really big rise this year. So if that 4% goes through, that is your wheels in motion of domestically generated inflation. That's what they want to see. That's the sort of news that we really ought to be reacting to.
So, Jane, that long-term forecast for inflation that comes from the Bank of Japan, should I view that as an honest view on where they think inflation will be, or just a signal to the market for where they want the market to believe policy will be?
Well, the government came out with a pretty similar forecast for core CPI. I think it was 1.5% for the next fiscal year, stripping out, some of the base effects because there have been some energy-related subsidies, for instance. So again, the government, the Bank of Japan, lots of economists are on the same page here. They think inflation next year will be lower than this year. And that is why they've got to be cautious, because we've got to remember a lot of the inflation that we are seeing, people are saying, Bank of Japan or Japanese inflation on the headline is firmer than in the US. Maybe they should be tightening, but that is really misleading because a lot of the inflation in that particular print is imported prices. Now, imported prices are not domestically driven. That's what they want to see. It's the opposite, really, to Europe, to the Bank of England, to the US. They want to see this wage price spiral, getting themselves up to sustained inflation around about 2%. We're on that road, but they're not quite there yet.
Is it a coincidence, Jane, that the Bank of Japan's tweak, I should say, comes after a real shift from both the Fed and the ECB moving away from forward guidance and away from committing to further rate hikes?
Well, I think the moving away from forward guidance sort of reflects the fact that the committees within those central banks are perhaps, there's bigger gaps between the doves and the hawks, because if everyone was on the same page, it's obviously easier to give forward guidance. But when you have this more diverse range of opinions, you can't really do that. And I think that's probably true of the Bank of Japan as well. I think there is a range of opinions within the Bank of Japan. If you read through some of their rhetoric, some of those policymakers are perhaps more ready to act on policy than others. But, a caution has always prevailed through the Bank of Japan because of its history with deflation and disinflation. And I think that is still here. And I think that's very evident in the commentary this morning from the Bank of Japan governor.
It hasn't just been the Bank of Japan that's been causing some waves. This week, there seems to be a feeling that both the Fed and the ECB may be done with rate hikes, which calls into question whether the ECB actually will end up hiking further than the Fed this year, which was the consensus heading into 2023. What's your view on this? Do we have to rethink this, that maybe both are at their peak and their rate hiking cycle over in Europe isn't going to be as long as many people thought it might be?
Yeah, we're coming down on the view that they may pause in September, that there may not be any more moves from the ECB. Some of the commentary from some of the officials from the ECB in the last couple of weeks, has been mixed. But there have been some comments indicating that perhaps core inflation could be plateauing, because obviously that's the focus for Europe, this core inflation, the stickiness there. But if we look at some of the economic data, for instance, those PMIs that we had for Europe at the start of the week, they were really quite worrying. If we saw, that the credit credit survey from the ECB too this week. Well, that showed that the higher interest rates are clearly impacting. So there are, recession is hanging above Europe. Germany, of course, already in recession. Recession risks are really very real, and that may give the ECB cause for constraint in September and pause policy. So we are data dependent. We have to make up, our minds on that according to the data. But there is certainly a risk that the market is going into the possibility of a pause in September whilst it's long the euro. And that's really important because I think positioning here is going to be adjusted. And I think the market has got very long the euro and anticipated with a very high hawkish ECB. And that might have been, overdone.
All favourite trades. Let's wrap up. Jane, downside on the euro. What is it?
Well, we've had, for a while now, a 3-month forecast for euro-dollar at 108. A few weeks ago, I think people, wouldn't have agreed with that. I think now maybe people are coming round to that. The market is very long the euro, and I think it's increasingly difficult to see that situation being justified.
Jane, thank you for getting on board with the programme this morning, following that breaking news from the Bank of Japan. Appreciate it. Jane Foley of Rabobank responding to the latest headlines out of the BOJ and the week that was. The Federal Reserve, the ECB with a focus on Europe. Here's a focus on America. Andrew Hollenhorst over at Citi, writing this just moments ago, just echoing what he's been talking about for a number of weeks now. Strong growth and softer inflation look like a soft landing, but we doubt the Goldilocks conditions, Lisa, can last for more than a couple of months. It's that summer sweet spot commentary all over again.
And how you interpret it depends really on who you are and where you're coming from, what your longer term framework is. Andrew Hollenhorst seeing a pickup in inflation, pointing to the employment cost index, saying that it will come out probably in about a half an hour now, saying that labor costs are just rising too quickly to get to some sort of immaculate disinflation. Again, okay, so if we get an ECI, if we get a surprise to the upside, does the market sell off? Is that a huge market mover in an increasingly data-dependent Fed?
Current output numbers, current labour market figures, inconsistent with a return to 2%. Most people assume something's got to give. Or the Fed just tolerates something higher, right, and just pushes out the timeline to get back towards that 2% line in the sand.
My theory that is very subtle and unspoken, so this is going to be first. I think people still believe in the immaculate disinflation. People still believe in the pandemic effects that are going to shake themselves out and have just taken a really long time. And so they're expecting the year-over-year comps to just come down and to return to a low inflation, low growth world because of aging populations and because of the overhang of debt. And that's a presiding sort of sentiment that is driving this sort of feeling that we're going to get to another place that is very, very familiar.
We'll get there in 2025, according to the chairman. Can you imagine if back in 2021, when they were playing the transitory game, that they said transitory is 4 years, we'll be back there in 2025, and for that reason we see no rush, no reason to hike rates aggressively, because there are some people who believe that the tightening cycle of the last 12 months hasn't even bitten yet, that the deceleration we've had in inflation has nothing to do with what we've seen from the Federal Reserve.
That it's just simply the year-over-year comps, and this is the disinflation post-pandemic. Key to watch the University of Michigan sentiment survey, which I know you love, but in particular, the longer-term expectations of inflation, and not just this survey, but in general, the longer it takes, is that when you start to see inflation expectations creep up in the market and among consumers?
I just want them to call me. That's it.
Public service announcement. If you are on the University of Michigan polling center,
the other end of the questions,
call Mr. Jonathan Farrow with his Tide Pods
long-term inflation
stacked up in a perfect neat
I just want to contribute to the survey. I want to be one of the 600. Isn't it a minimum of 5? Is it 500 or 600 people?
You should say, I believe inflation is going to be 3.1269.
No, I'd go with a crazy number.
That's why they're not going to call you.
Yeah.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others.
Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
It's a hurricane over real estate right now. We're in the Category 5 hurricane, and it's sort of a black cloud hovering over the entire industry until we get some relief or some understanding of what the Fed's going to do.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Quantitative tightening is really kicking in now.
Parts of the economy are definitely feeling the strain from higher interest rates.
The pace of this cycle is very different than everything that we've seen before.
This cycle is aiming to finish up sometime in the fall.
Soft landing, the market sniffed that out sometime in June. Earnings, though, thus far have been pretty confirmatory of that outcome.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
We should do what the Europeans do. Vacation for a month. Didn't you feel that from the Guard yesterday? I was like, we're done and we'll see you after the summer.
I love this. You're not even subtle about it. You're lobbying the central bankers, basically. Why even show up to anything?
Shut the market for like 30 days. Everyone goes away for August. Beautiful thing. From New York City this morning. Good morning. Good morning. It's my reason and my purpose in life in New York City is just to convert America to the European view.
How's it going?
On vacation. It's going really well. Where's TK?
Exactly. I was about to say.
TK's on vacation. There you go. Alongside Lisa Abramowitz, I'm Jonathan Farrow. Your equity market on the S&P 500 positive by 0.5%, wrapping up a monster week of central bank decisions and earnings as well. And a little bit of breaking news from a central bank where a week or so ago we didn't expect it to come from. The BOJ, Lisa.
They tweaked their policy to allow some flexibility in the upward limit of the band, allowing 10-year treasuries to, or 10-year JGBs rather, to trade at a slightly higher yield. I should say trade in quotes because it's unclear who's trading them. But here's the question. How long can we see a calm in markets that yesterday seemed a bit jittery on the heels of rumors of this, but the actual delivery of it has really landed with this incredible finesse.
You know what? A journalist should actually do that. Go find that one person
100%
that traded BOJs, JGBs like a week ago.
I was actually thinking about that. Maybe they could call the 3 people who actually trade JGBs.
Who trade with the BOJ.
Exactly, and just say to them, okay, what's the word? What are you going to do with this? What's your interpretation? Because that predicted everything.
The market.
At least.
Half the market. We've sort of lost perspective on what's happened over the last 10 years, and you wrote about it extensively. We have a central bank that owns half of the government bond market in Japan, who has set a limit for how high yields can go, which essentially is setting a limit on borrowing costs for the Japanese government at 0.5%. And they've come out this morning, and we're talking about it as breaking news. Just to reset the conversation. Imagine someone's tuned in to this program for the first time ever. Welcome. And you're trying to explain to them that this country exists, a developed country, that is buying pretty much all of the JGBs, all of the government bonds, and capping interest rates at 0.5%. And we're sitting here and saying it's news that they might tolerate maybe a breach of that level and perhaps come in when it gets to 1%.
Right.
And that's like this monster move, because relative to the last 10 years, apparently that's introducing just this little bit of market discipline back to the Japanese government bond market.
To take it even a step further, they've also been buying stocks through the ETF purchases. So it's not just bonds. They've owned an entire market. So why should we care? Well, for a number of years, people said if they abandoned this on the heels of inflation that Japan is seeing as well, that could disrupt all of markets and send yields in developed markets surging higher as people move back to the Japanese market and buy JGBs. What we've seen this morning on the heels of this tiny maybe move, maybe not, they're saying it's not a move, we're seeing calm, and some people are saying this might give them the freedom to go even further.
Do you want some good news out of Germany?
Of course.
It's not the growth story, it's the inflation story, and this is what sounds like good news in Germany these days. 6.5% CPI. That's a downside surprise, by the way, month on month and on year over year. EU harmonized year over year. 6.5% CPI, Lisa, out of Germany.
I could just hear the cheering. I mean, great. That's good. It came a little bit in below expectations, although if you take a look at consumer prices in line, 0.3% month over month, as you were saying. So are we seeing victory here, that basically a slowdown in economic growth does lead necessarily to a slowdown in inflation? Or does this just give you a sense that this is, I don't want to say the sick dog of Europe, but right now kind of the economy that's doing the worst among all of them?
Describe the dynamic. 0% growth, 6.5% inflation. What is it called?
Stagflation.
Right. Did that come up in the news conference yesterday at the ECB?
Did not, no.
Why not?
Partly because it's Germany, so she's not going to address a specific nation, but you're right. Why can't you say, how difficult is it for you at a time where Germany is in stagflation to be creating a policy that also deals with a real growth picture and inflation in both France and Spain?
Just totally obsessed with the next move. I was really disappointed with the news conference of both the Federal Reserve and of the ECB, the obsession with September, just the absolute obsession with September. Because many of the questions in those news conferences are asked with the purpose of trying to get some headline that moves markets. And you can see every individual in there trying to achieve it. So they consistently ask about September.
It's a great point, rather than try to understand the theory that they're following.
Totally.
In order to decide whether or not they need to further rate hikes.
And can I just say, Mike McKee's the exception he always is.
100%.
Because Mike's a great friend of ours. Steve Chevron joins us now, Head of Multi-Asset Solutions at Federated Hermes. Steve, wonderful to catch up with you. You mentioned the pain trade in this equity market may well be a higher equity market. Just walk us through it, Steve.
Yeah, I mean, it's been the thesis that we started with in January when we went back overweight, which was that, look, even if recession risks do materialize at some point, and that's still an open question, it's not today, and tomorrow doesn't look good, John. I mean, you look out, if you're still in a position of tight labor markets, inflation that's sticky, a Fed that, at best is maybe pausing, may still be in the hike cycle. We'll see what September and November bring, but is certainly not anywhere near, a place where they're cutting. Historically, that's not an environment where you have big equity sell-offs. If you look, Fed pauses are really good for equity markets. 15% returns on average, 20% max rallies, drawdowns that are relatively small. And so I think that you're in this scenario, and I heard you mention in the prior segment this idea of a kind of summer window. I don't think it's a summer window. I think this goes higher for longer, and I'm talking about equity markets right now. So we see upside through the old highs, even if storm clouds do eventually, materialize. But we don't think it's soon.
So, Steve, upside where? Because people are willing, or at least want to, shift away from the tech winners. They want to think about maybe the things that are left behind, cyclicals, banks, energy, take your pick. Steve, how are you thinking about that?
Yeah, so again, if you look at both Fed pauses and then even once you get into Fed cuts, cyclicals tend to do better than your kind of defensive growth names. Also, a 27 times multiple for the Russell 1000 value. That's hard for us to kind of just hold our nose and buy. So what we're buying is everything else, pretty much. So we've been overweight value, particularly cyclicals and the defensive dividend payers, a little bit as a hedge. And then our newest buying has been in small cap growth. The idea is that it entered its sell-off a year before. Those names are still down 20% on a 2-year basis. And while valuations look high on an absolute basis relative to where they were 2 years ago, we think they're attractive. So if there's any disruption to the kind of big tech and growth names, it's going to be those smaller companies we think that emerge. And we just think that offers a much better kind of upside scenario. So it's really cyclicals. Yes, a little bit of those defensive dividend payers, but then also the small cap growth where we think there's some better opportunities.
I want to point to something that Torsten Slok wrote that John was talking about earlier of Apollo, where he wrote, for markets to continue to trade higher, the soft landing must be a soft landing, not a reacceleration. And he's speaking, of course, about inflation. How much does your bullish call hinge on inflation not reaccelerating and continuing to go down?
Yeah, so, in the list of things that you need to watch, I'd put that in there. You've gotten the housing market and home prices have shown some signs of reacceleration. I know we've all seen some of the labor deals that have come through. We're watching wages. Our expectation is that you will see some reacceleration in at least a headline number in the back half of the year. That's just math, Lisa. I mean, your toughest comps or your easiest comps, depending on how you want to think about it, were really in the first half of last year. As you get to the back half, just the base effect should take you up. So we still have a 3.9% core CPI forecast for this year. If it was materially higher than that, and we're talking about a Fed then that is forced into, much more aggressive policy action, again, that could have some disruption. But if you look, there has never been a market in the last 40 years, an S&P 500, that was negative during the hike cycle. There was never a market except for one that was negative during the pause cycle. And so it really is, once that economic data has deteriorated and you're in a cut cycle, that you start to worry about those big downsides. But it's hard to see us in that scenario in 23. And that's the story, that if you're a soft landing person or you're someone who sees a kind of new bullish trend here, being overweight equities obviously makes sense. Even if you're someone that's cautious, though, the historical track record suggests that for some time, and not a very short period of time, you probably still have upside risk, at least through the old highs.
When do you know it's gone, Steve, the upside risk or the upside potential for some of the risk assets?
Yeah, I think what you watch and what we're watching are going to be spreads. Spreads are one. When you start to see spreads move up, I think you need to see a little bit more deterioration in initial jobless claims. You've got to at least get to that 300,000 level before you can start to really think about a material deceleration in the labor force. The unemployment rate would need to kind of creep up on the back of that. The yield curve, not just being inverted, but starting to re-steepen would be a sign. If you start seeing that yield curve get back towards zero, historically, that's a sign that that's starting to happen. Bond yields that are falling. You get the theme here. Those are all the things that I think the most bearish folks thought would be happening already. And granted, even though we saw a first half rally, I might have expected to see more progress in that direction so far this year, but it hasn't happened. And so until it does, you've got to stick with the regime that you're in.
Stick with it. Steve, that's the message. Thank you, sir. Steve Cheverone of Federated Hermes on this sweet spot in the market that he thinks can last a whole lot longer than many others do. This just in from the Bank of England. Here's one. The Court of the Bank of England is pleased to announce that Dr. Ben Bernanke has agreed to lead a review into the bank's forecasting and related processes during times of significant uncertainty. Lisa, I think this is the Bank of England basically undergoing a review after getting the inflation call so wrong. And they're not alone, of course, but interested to see a central bank conduct this kind of review and getting someone on the outside like Ben Bernanke to come in.
Trying to get the credibility and to retain the confidence of its independence at a time when a lot of people are questioning how some of these central banks could get things so wrong. I do wonder who's next, right? Could you see the Fed getting some sort of external board of former Bank of England members to discuss what they potentially could have gotten wrong with transitory inflation?
Sure. I think we need a big committee, don't we, with the people who got it right for a start. And I'm not sure that was Ben Bernanke.
There is that too.
Right? Couldn't they have tapped someone on the shoulder that got it right?
Well,
okay.
Who did?
Mohamed Al-Arian.
Okay, that's true. I
Larry
thought you
Summers.
meant central bankers. Yes, that's true.
No, I mean, you can pick an outside external economist who got it right and come in and have a chat. But it's one for another day. From New York City, welcome to the program. Your equity market positive on the S&P 500. On the NASDAQ as well, on the S&P positive by 0.56%. Jonathan Pingler, UBS, coming up very shortly following the latest US economic data. The employment cost index is just around the corner. But Lisa, don't you agree that if you're going to tap someone to do a review, tap the person or people who got the call right on inflation and what went into their forecast, their thinking, what process did they go through that enabled them to come up with a completely different view to the consensus on your committee?
Mohamed Al-Arian, if you're watching right now, if you would like to be tapped on the shoulder, please let us know.
Mohamed can speak for himself. I'm not going to speak for
I'm
Mohamed.
just kidding. Yes, no, I understand.
You want that external influence to come in. I think there's something to be said about that. But then you tap sort of that establishment figure that was very much with the consensus on where inflation was going to be.
It's an important point. How do you gain credibility at a time where people are worried about groupthink in some of the central banking institutions, where there is a feeling that everyone needs to get on the same page? And if they do have a different view, they're often pilloried in public opinion in the economics profession. So how do you get the sense in the public that this is an independent body, one that does have the credibility of independent thought, not just that groupthink?
Bloomberg subscriber just moments ago, so this is not my view, it's theirs. The bloke who printed the money to cause inflation to review the problems caused by printing the money that caused inflation. That's one view. Other people might push back, of course. Henrietta Trays of Vader Partners in Washington, up next.
London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
It's a hurricane over real estate right now. We're in the Category 5 hurricane, and it's sort of a black cloud hovering over the entire industry until we get some relief or some understanding of what the Fed's going to do.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise? It's noise. It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
Earnings season is here.
Decent start to earnings season.
We are heading into the meat of earnings season.
Bloomberg breaks the numbers first.
We have Bank America, we have Charles Schwab.
Tesla, Netflix, you name it.
They're heading in the right direction.
A record quarter of revenue.
With exclusive expert analysis.
What do they have to deliver to justify the rally we have seen?
Earnings are still going to be under pressure.
Is there a divergence that's really important to draw here?
The massive divide between Diamond and Fraser.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Chair Powell is pretty confusing. He wanted to assert very strongly that every decision is, every meeting is live, that every meeting is made based on the data. But in fact, there seemed to be guiding us to a slower pace of policy. That sounds like a committee that is, number one, divided, and number two, pretty close to the end.
Such a thoughtful guy. Vince Reinhardt there, the chief economist and macro strategist at Dreyfus and Mellon, on the latest from Chairman Powell, and responding to the economic data just yesterday with Lisa following GDP and jobless claims. Later this morning, about 13 minutes away, the Employment Cost Index, the next big one to watch, the ECI, as it's called. Labour market pressures, what do they look like? And do we see further deceleration in wage growth, that kind of disinflationary theme that's breathed some life, some oxygen into the soft landing hopes and dreams of this equity market? Your equity market this morning, a lift on the S&P 500, up by 0.56%, on the NASDAQ, up by a little bit more. It's been quite a week for the economic data and for the earnings as well. In the bond market, yields lower by 4 basis points, 395.26. Yields lower on a day that things have been shaken up just a little bit at the BOJ, but as we've repeated this morning a few times, Lisa, this because we had the strong lead from Nikkei's reporting about what would probably come this morning from the Bank of Japan.
And that lead was a bit more aggressive than the actual move itself. But as you've mentioned several times today, it's still too early to write the book on what this looks like, because it's also too early to understand what exactly they're going to be doing. The proof is in the pudding of how this stuff trades, if it trades, but whether it actually does end up with the yields going materially above the band.
You say if it trades, and I think it's worth just sort of fleshing that out just a little bit. There are days in the Japanese government bond market, market, a term we use loosely here, where nothing trades, where the Japanese 10-year does not trade at all.
Well, and this is the conundrum. Why trade something and make a bet when you could have a whale that will come and crush you and will decide, I don't like that. That doesn't work for me. Boom, I'm just going to snuff that out. And that really is the reason why we might not even get that big of a move, because it's unclear exactly how far this Bank of Japan will actually do.
Where's the line in the sand? Is it at 60 basis points? Is it up closer to 1%? And I guess maybe we'll find out. Joining us now, down in Washington, Henrietta Trace, the Director of Economic Policy Research at Vader Partners. Henrietta, wonderful to hear from you, to have you on the program. You know the story of the week, it's been about the age of Washington, D.C. What is anyone going to do about it, if anything at all?
Right. I mean, unfortunately, I don't think it's a particularly new story. We've experienced this as far back as I can remember, and certainly before then. I think one of the things investors are really trying to get a handle on right now is, you know, if there is a vacancy, how fast is the seat filled? What does this have any immediate impact on? Are we still going to see legislation push through as we get into September? And I would point to the Appropriations Committee, which in the Senate has, 51-49 split, as bipartisan as you can get. And they have pushed all 12 appropriations bills out of the committee for the first time since 2018. So I think that even split is weirdly helping in the Senate at this point. And if a few members are no longer in office and they will be replaced with members of their same party, you will keep that same sort of status quo of a very slim Democratic majority, a Republican minority. And the biggest change would just be in sort of directional leadership, since we are talking about the minority leader, Mitch McConnell, who has been the leader of the Republican Party for the longest of any Republican serving in that role. So I think the leadership direction is also really interesting. Is he continuing to, give Speaker McCarthy free rein? Would leadership continue to support Tim Scott for president over Donald Trump? Those leadership decisions for the party at whole, which are so different in the Senate versus, say, the House or even the Republican Party, far-right fringes or the support of President Trump, those supporters, it's a marked difference. And I think whoever replaced McConnell, if he needed to be out of office, would be someone who would try to continue those things, but it'd be difficult because McConnell has really done a differentiated job on that run.
How are you expecting this issue to shape the campaign in the next 18 months, particularly for the Republicans next month in that first debate, when someone like Nikki Haley has already put this out there and asked for so-called competency tests from leaders in Washington?
It's not the first time we've seen somebody ask for a competency test for leaders in Washington. You could even say competency tests for voters. I don't think any of that is going to move. The threshold for support is just way too high. So you'll hear that argument. Unfortunately, it does span both political parties. You do have very elderly leaders in both sides. So it somewhat negates the argument since everybody is doing it. So obviously, it's a frequent refrain we hear against President Biden or really many of the leaders. And both sides of the aisle, Republicans and Democrats, have very old members in the House and the Senate.
There are a lot of people who say one reason this has persisted is because voters don't care, and they continue to vote for people regardless, and they take a priority on the idea of name recognition and years of service over a new entrant. What is the impact of that on younger voters? Are we seeing any sort of shifts there, or is it pretty much status quo?
You know, it really is much more obvious to see the changes based off of what a candidate votes for, not their age. And we could use the last election as an example. Name recognition is humongous. You know, Chuck Grassley has incredible name recognition in his home state, and it's unlikely that he would ever be defeated if for no other reason than that, despite what he's, you know, given to his constituents. But I would say that the number one piece that you're looking for is for younger voters is a focus on things like abortion and climate change. And it doesn't matter how old you are if you're able to get those things right. And then you have President Biden working on student loan forgiveness. You know, that's obviously a youth voter and supported initiative, and that is where Biden gets his support despite his age. So it's really on those three issues, climate change, abortion, and student loan issues, things like that, that voters tend to flock to if they are a younger voter, and the older voters would focus more on immigration. The economy is always top focus. For Democrats and democracy now, democracy actually polls as the second highest important issue for voters across the board right now, which is a really interesting argument. And, you know, in some circles that's anti-MAGA, in other circles that's, you know, anti the Biden administration. So those issues are really invigorating voters.
Henrietta, sorry, I've got to jump in. We're now saying that democracy issues are both anti-MAGA and anti-Biden. Can you explain that? How is democracy anti one party or the other?
And both.
Sure. It's a morning consult poll that they do like every week. It's fascinating to watch the trends, and that's what I focus on a lot. And the economy is persistently the number one issue, right? Everybody always says that. Then the second issue is this vague sort of democracy. And I want to apologize. I think it's actually a Quinnipiac poll that does that. So democracy, the value of your vote, the ability that you have to go vote, you know, all issues that Donald Trump railed against. Both before and after his election, things like mail-in balloting. Those are all sort of democracy issues that you could have an issue with the Democratic Party on. And then on the left, you look at things like the insurrection, the special investigations that are occurring right now. The indictment of President Trump today is going to be on election issues and democracy. Did he try to take away the rights of American voters to actually vote? Did he try to nullify their votes with Vice President Pence, et cetera? So both sides of the aisle have a way to say that democracy is critical to them, and it polls as number 2 in some polls.
Amazing.
Issues.
Henrietta, thank you. Henrietta Trace there of Vader Partners. Amazing, isn't it? How divided things are across things like that.
Tribal politics. That's what this has become. And the other side is destroying the fabric of the nation. That has been basically the feeling on both sides. And so what do you get where you can come together and actually talk about issues and things that people can agree on and have common ground?
That would be nice, wouldn't it?
It would be really nice, but it wouldn't really,
unfortunately,
sell in the same kind of way.
No, that's not politics.
Exactly.
Right now. Coming up, there'll be plenty of that on the Open in about 35 minutes, just people throwing stuff at each other about markets. Monica Defend of Amundi. Jim Carron of Morgan Stanley, very aggressive chap. Cameron Dawson of UH12.
Oh, yeah.
All of that and more.
Tribalized markets.
That's a beautiful line. Tribalized markets on Bloomberg TV and radio. From New York, equities positive. We're almost there. You can hear it in my voice, can't you?
No.
We're a few hours away from the weekend. This is Bloomberg.
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
3 prime ministers, 4 chancellors, an energy crisis, and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
Just moments away from a slew of U.S. economic data, including the employment cost index, a sense of just how hot or perhaps cooling the U.S. labor market is and how much wages are rising, as well as personal income and spending. Also, the PCE deflator. This is the key metric that the Fed watches to understand the direction of inflation in markets. Not a whole lot of drama. Gains in the equity markets, a bit of a retracement from yields going higher yesterday on the heels of that Nikkei report talking about the Bank of Japan eliminating yield curve control. Didn't quite do that. We've been talking about that this morning. Right now, the data is coming in. We're joined by Michael McKee of Bloomberg. Mike, what do you see?
Well, we got some big numbers this morning that are important. We've got the employment cost index coming in a little bit lighter than anticipated and down from the prior quarter. It comes in at 1%, down from 1.2% in the first quarter, which would be good news for the Fed. We'll get the breakdown on that and see what the wage component was in just a moment. Personal income rises 0.3. That's a little less than last month's 0.4, and down from the 0.5, the 0.5% that was anticipated. Actually, the May number was revised up to 0.5%. So slowing there, but we did see that in the overall GDP numbers. Spending comes in at, as I said, 0.5%. Real personal spending at 0.4. So not a huge inflation effect. And then those PCE numbers that everybody from Lisa to Jay Powell are watching. The deflator comes in, the headline number comes in at 0.2%. That's a little bit faster than last month, but this, well, it was what was forecast. And so on a year-over-year basis, headline PCE is 3%. The core is 2%, 0.2 gain. So that comes in at 4.1%, and that's lower than anticipated and certainly lower than 4.6% last month. So, Lisa, we've got basically the same story we've had for much of this week. The data come in line kind of with what the Fed wants. Not all perfect, but better than it has been.
Suggesting a slowdown in inflation while retaining some of the strength of consumer spending and growth. The market reaction isn't that significant based on the trend that this just continues. Stocks just edge slightly higher, the NASDAQ leading the way up more than 1%. You can see two-year yields just edge slightly lower in response to this, currently at 4.85%. You could see the euro dollar, which has been moving all over the place, and there had been a bit of dollar strength and then people reassessing. We don't see a huge shift there. A euro strength, dollar weakness, that continues with a 0.4% gain. Mike, when I'm looking through these numbers, it does seem to confirm this Goldilocks scenario of slowing growth, slowing inflation, but still robust consumer spending. How reliable, how significant is this data showing an upside surprise of personal spending even as incomes fall off just a touch?
Well, it's kind of what the story we've been seeing. It is interesting that we get a little bit of an upside surprise in personal spending because the GDP numbers suggested consumer spending had fallen off. So maybe that was weakness in April and May, and June comes in better, which sets you up for a little bit better spending going into this third quarter. And obviously, we've got back to school coming up, which will be an important measure for retailers. The other numbers that come in better than expected, they're not going to have a huge impact right now because we get a lot of data between now and the next Fed meeting, but it does show that things are going in the right direction. And so maybe Jay Powell gets the board of governors together and they all go out for happy hour today or something.
Well, or they just go take August off, as Jonathan has been talking about all morning. Mike, please stay close. And as you look through the data, we will get more details in just a little bit. We have with us someone who has been at the Fed who might tell us about happy hour after getting good economic reads. Jonathan Pingle, chief U.S. economist at UBS, who is not at happy hour currently, sitting at his office. I'm curious from your vantage point, Jonathan, how much conviction you can have in this soft landing narrative when we keep getting data print after data print showing, disinflation, robust growth, this feeling that maybe we will just immaculately get price stability.
Yeah, I mean, this is certainly good news, but we're still actually a long way from price stability. I mean, I think, looking at today's employment cost index data, as sort of Mike was saying, as well as the core PC deflator, the year-over-year change falling to 4.1% puts the Fed actually within striking distance, 0.2 of their sort of full year projection for later this year. But even at 4% or the Fed's 3.9 in Q4, you're still a ways away from what you would call price stability. So everything looks great now. I mean, looking at, Mike was mentioning real spending coming in a little stronger. We'd actually sort of expected the 0.4 increase, and he's right. I mean, we ended up revising up our Q3 consumption estimates after retail sales as a result. So this is all good news, and the economy has certainly proved resilient, but they do have this problem that we're making progress on inflation, it looks like, but we're not actually at 2 yet, and there's actually a pretty big gap between now and how we're going to get there, and a lot of uncertainty. But at the moment, Lisa, yeah, the data looks good.
What's the bigger risk right now? That we're wrong about inflation just steadily coming down and we see a reignition of some of the price increases, or that the economy slows down more dramatically and that the strength that we've seen recently perhaps isn't indicative of the longer term trend?
Well, I am pretty worried that this economy is going to slow meaningfully in the coming quarters. There are a lot of positives right now, but there are also headwinds. And I still kind of agree with Chair Powell that there's still follow through from the monetary policy tightening. I think there's still excess savings that's percolating through and supporting spending. And some of these forces could diminish. We also have things like student loan repayments coming up. I mean, there's a number of headwinds and challenges that we're still going to have to face as an economy. But I think you've nailed the sort of risks on the head, right? Because everybody, of course, would like to have a soft landing and not have job loss and have this continue. But the initial conditions are a little tough. And by initial conditions, I mean, we're starting with a low unemployment rate. Even with the ECI at 1%, I mean, I think that's going to be great news at the Fed, take a little bit of the wind out of the sails of the more work to do component of the committee, but that's still a little over, it's 4% annualized, and the Fed kind of needs it to get it down closer to 3.5. So you got a low unemployment rate, nominal wage inflation that's still a little brisk. If the economy stays strong, there is the risk that the Fed might have to hike more and do more work to get the slowing that they need in the economy.
A lot of people, Jonathan, have been talking about how it's been easier to get a disinflationary trend just simply on the year-over-year comparison numbers, at least over the past few months. What changes? What areas of the inflation overview are you looking at? Is it housing? Is it car prices? Is it something else that could fuel some sort of strengthening in the inflation reads?
Well, I mean, it's all of that. I mean, I don't think the details of the inflation data in my career have ever been as looked at as they are today because of how crucial it's been for monetary policy. But when we think about, sort of what's unfolding in the various chunks of the basket, I mean, I think there's people have talked about, super core and sort of these measures. I mean, I don't want to put a label on it, but when we look at some of the services components that are most linked to wage inflation, many of them also have relatively persistent components. I think we can get comfortable with the goods disinflation and we can see it. And I think, we're watching sort of, OER and rents slow and the CPI data. But, these other services, are really sort of what I think is worth watching for where the improvement could come, or what might reaccelerate because of the low unemployment rate. And that's one of the reasons I think Chair Powell in his press conference went ahead and mentioned the ECI as sort of one important data point they would get between the July and September FOMC meetings.
And if you're just joining us now, we did see the ECI, the Employment Cost Index, come in at 1% for the second quarter. The expectation had been 1.1%. It was down from 1.2%. Personal spending coming in stronger than expected at 0.5%. Personal income coming in softer, so people making less and spending more. Michael McKee, you've been digging under the numbers. What do you see?
Yeah, let's look under the hood at a couple of things that Jonathan was talking about. The ECI for wages goes down to a 1% gain from a 1.2% gain in the first quarter. And that would be considered reasonably good news. But then when you look under the personal income figures, wages went up 0.6% in the month of June. And that is up from 0.5%. It is actually the highest increase since January. So we have two sort of contrasting views of what wage pressures are doing at the moment. And John mentioned, as we do every time we get an inflation figure, the super core, which is Jay Powell's favorite thing. Core services ex housing comes in at a 0.2 gain, 0.22 if you want to round it out to three figures, and that puts it at a 4.1% increase for the year, which is going to be your lowest since basically last August. So things moving in the super core direction, take out housing out of the equation, and services for the PCE, like the CPI, are down. But the wage numbers still healthy, and that suggests consumers can still keep spending. The question is, will the Fed see that as inflationary?
Jonathan, as we talk about these numbers, 4.1%, down significantly from what it had been, from 4.6% the previous reading. When's it enough? Are we heading back toward 2%? Or, to the conversation we had with Richard Clarida, are we looking at a 2.5 or something somewhat above the target that the Fed's just going to live with?
Well, I mean, so this is a question they're going to have to answer at some point, I think, next year. At the moment, obviously the 4.1 is not enough. I do think it's pretty relevant, though, for sort of the meeting by meeting decisions they're going to make going forward. I mean, at 4.1%, they're only 0.2 percentage points away from their full year core inflation projection already in the June data. So they're clearly making some progress. The other thing they're making progress on is real rates. This is going to widen the gap between the funds rate after the rate hike on Wednesday to a level that hasn't been around since 2007. So they're making progress in terms of restrictiveness, not just because of the rate hikes now, but also because they're making progress on inflation. Now, a year from now, let's say inflation is moving down to 2.5%, they're going to have to make a decision about how hard they push to get it back down to 2.0. I mean, I do think that monetary policymakers would like to actually get it back to 2.0 for their credibility, to show that they can do it. Are they going to really work very hard to run it at 1.8 so that they can show that they're on both sides? I don't know that that's worth really costing a lot of people their jobs, but I do think they're going to leave, if they're struggling to get back to their target, I think they probably would leave restrictive policy in place for a while.
Jonathan Pingle of UBS, thank you so much for taking the time. If you're just joining the program, right now we are seeing a bit of a rebound in the S&P, in the NASDAQ, the S&P 4593 up 0.6%. What we are looking at right now is economic data that's supposed to matter so much more. And still with me is Michael McKee, our Bloomberg Economics correspondent. which data matters if we have this increasingly data-dependent Fed, an increasingly data-dependent ECB? Okay, well, the market's not moving too much on the heels of this. When's it going to matter?
Well, it's not going to really matter until you get into September because we have the August data. Well, we've got all the July data yet to come. We start next week with the ISM and the jobs numbers, and then you get the September jobs numbers. You get August jobs numbers in September, and we get more CPI numbers in August, more PCE numbers. The Fed's going to have a lot of data between now and then that could change. Right now, the situation looks pretty good, which is why I'm expecting Jay Powell to be buying at the happy hour this afternoon. But the when you look at the inflation numbers, they're moving in the right direction, which is what they want to see. And interestingly enough, and maybe this will have, we'll have to get a breakdown from John Farrell once the markets open about goods, whether we're seeing consumer staples rise or something like that, because goods spending rose faster than services spending.
Interesting.
According to the government in the month of June.
Yeah, well, Hermes earnings came in better than expected because of Birkin bags that were going up at a pretty significant pace.
Tom was spending on.
Yeah, exactly.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
The names that move markets are on Bloomberg.
Concentration in industry after industry after industry is a threat to our economy. It is a threat to innovation, and ultimately often leads to price gouging, whether it's consumers or the government. I believe in the power of markets, but they only work if we enforce the rules that keep competitors going rather than monopolists.
Nobody covers business like Bloomberg, your global business authority.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
Activity in the housing sector has picked up somewhat. It remains well below levels of a year ago, largely reflecting higher mortgage rates. And higher interest rates and slower output growth also appear to be weighing on business fixed investment.
That was the one and only Jay Powell, the chair of the Federal Reserve, speaking at his press conference where he sought to, I guess, achieve strategic ambiguity, or just to say as little as possible, as he looked toward some sort of free market kind of strategic decision-making policy, something like that, basically. We don't know what they're going to do next. Right now in markets, we do know that there's a little bit of a lift following the sell-off late yesterday on the heels of a Nikkei report that the Bank of Japan was going to eliminate yield on the NYMEX level. Right now, I want to drill into the one area people always say is the caveat to those who say, we're seeing immaculate disinflation, the market is right-sizing itself, and we are going to see prices stabilize. Danielle Hale joins us now, chief economist at Realtor.com. Everyone talks about the housing market as the lone outlier. We saw it bottom out. Some say now we are seeing a reacceleration. Danielle, can we start there? Are you seeing a reacceleration in housing prices, in housing demand, in housing availability?
Yeah, when you look at some of the month-to-month numbers, you are seeing a bit of a pickup in pricing. And when it comes to demand itself and sales, they're actually still at quite low levels. Pending home sales in the most recent data we're up month to month 0.3%. So I think it's a far cry from a reacceleration. We're sort of roughly flat at low levels, maybe grinding very slowly higher. Prices have surprised on the upside because a lot of forecasters were expecting major drops in prices. We were not a group that forecasts big declines in prices this year, but I think it's fair to say we are still seeing prices roughly on par or weaker than a year ago. So we're not seeing the big inflationary run-up in prices that we had seen over the past few years. It's a slow adjustment, but it is adjusting.
Well, nonetheless, a lot of people expected pretty significant declines in pricing, given the fact that we see mortgage rates at 7%. The logical conclusion was this would be the transmission mechanism for benchmark rates going higher. Is anyone who you see buying a home actually paying 7% interest rates?
Oh, yeah, consumers are paying 7% interest rates. We are, a significant portion of the market is, purchases a home with a mortgage. So it is an important transmission mechanism. But it is important to consider as well that only 4 to 5 to, during the pandemic, up to 6.5 or so million homes transact every year. The vast majority of homeowners don't move, so they don't actually experience a change in what they're paying each month for housing, unless maybe they choose to refinance. And there were a lot of households that took advantage of low rates during the pandemic to refinance. And so now we've got a significant portion, 65 to 75% of the market, that are locked in with mortgage rates below 4%. And that creates a very strong disincentive to moving because it raises the financial threshold at which it makes sense to move. In other words, your house has to be a really bad fit for you to decide that the higher costs that you would pay today for a new home are worth moving.
Which is one reason why rents have gone up in certain areas or had been going up in some areas disproportionately, because people didn't have the inventory to buy. They didn't have the wherewithal to buy at 7% mortgage rates. At what point, we have seen rents come off just a bit. Do you expect to see a reacceleration in rental costs at a time where the backdrop for the sales market hasn't really changed materially?
So we don't expect to see a reacceleration in rental costs. I think that is a little bit different. When you look at supply in the rental market, there's a lot of it that is coming. The number of multifamily units that are under construction right now is at an all-time high, and a lot of those are going to be finished and hit the market at a time when we have seen a bit of weakening in rental demand already, and rental prices have started to decline. By our data, we saw a drop from a year ago in both May and June. Now, again, it's somewhat regionalized. We're seeing declines in the West and in the South. The Northeast and the Midwest are faring better, largely due to better economic conditions in the Northeast, better affordability in the Midwest. It's interesting to see this pattern reflected in both the rental market and the for sale market. We also did a joint release recently with the Wall Street Journal on the Emerging Housing Markets Index. And again, Midwestern markets really dominated the top of that list. So we're seeing economic fundamentals impact the housing market as we typically do. And that is leading to these nuanced performances in the Midwest and the Northeast versus the South and the West. But on the whole, we are seeing rental prices slow. We expect that to continue as we see more supply come online really across the country.
So this is a reason why I'm asking. We've been talking about economic indicators, economic data, whether we see inflation decelerate or reaccelerate heading into year end. And a lot of people point to the housing market, the resilience, the fact that it's turned a corner as evidence of new strength and new pressure on inflation. Do you buy that argument?
I think it's too soon to say that we've totally turned the corner. Even if we've had, it's really that the decline has stopped, but it's not that we're seeing this massive increase. Housing is very seasonal, and I think it's interesting to see people focus so much on month-to-month changes, which we know can be a bit noisy. I mean, if people were looking at the CPI in the same way, they would say we're already back on target. Because if you annualize the monthly rate of change, the CPI for both headline and core inflation in the last month was back to 2%. But no one is doing that, because we know that monthly data can be a bit volatile. And we have seen some pickup in the housing market because supply remains low, because transactions remain low, and it's hard to see prices fall too much when you've still got a decent amount of demand with respect to supply. But I don't think we're totally out of the woods in the housing market. And I think we're still going to see prices move largely sideways because affordability still isn't there for most households.
So if the housing market is a microcosm for the long and variable lags, how long does it take for higher rates to really impact the valuations in a market that a lot of people said was inflated dramatically by low rates? How long does it take in an era of 30-year mortgages?
You know, I think it really depends on what happens with the broader economy, because it's not just the interest rate channel that matters for the housing market, but it matters for the broader economy. The broader economy has managed to surprise and surpass expectations of the last year. The unemployment rate remains quite sound. Wages continue to go up faster than many would have expected, given the huge increase in rates that we've seen overall across the yield curve. So I think as long as, you know, incomes remain relatively healthy, we'll see the housing market move largely sideways faster than many would have expected, given the huge increase in rates that we've seen overall across the yield curve. So I think as long as, you know, incomes remain relatively healthy, we'll see the housing market move largely sideways. So it will just take a long time for those home prices to get back in line with economic fundamentals like income and the share of income that people are putting towards their housing. But make no mistake, right now people are putting bigger chunks of their income towards housing than they have historically, and that is straining budgets and limiting the number of households that can actually participate in this housing market right now.
We're about 36 minutes away from the open, and now it's time for your weather report, where I asked Danielle whether the extreme heat wave has caused a rethink of any of the shift down to the Sun Belt. Have you seen anything?
Oh, that's interesting. So, you know, as I noted earlier, we have seen better performance in the Midwest and in the Northeast. You know, I think that's more driven by economic fundamentals than any sort of climate relocation. But I think that's an interesting question. And if you look at our cross-market demand data, I will say a lot of people still moving to Florida, but there are also a lot of people relocating from Florida to further north into Georgia, into other states in the Southeast, like the Carolinas. So I think it's too soon to say whether that's climate driven. But we do know that consumers are interested in climate information. We've got a lot of climate information on the Realtor.com site, information on flood risk, information on fire risk, so that consumers can have that information when they're thinking about buying a home and shopping for a home. So I think it is an important consideration, but it's one of many in a market where affordability is still top of mind. I think, you know, consumers are trying to make the best decision they can with a lot of different information that they're trying to take into account as they're buying or choosing to buy.
Danielle Hale of Realtor.com, thank you so much. Have a great weekend. As we look forward toward the depths of summer, coming up at 10 a.m., we do get the University of Michigan sentiment survey, including the 5 to 10-year inflation read. Interesting to see whether, if it does take a really long time to get back to 2%, it starts to shift upward at all. The sentiment in the general population, and perhaps not Jonathan Ferro, who hasn't gotten called yet. They can still call him. He might give you a pretty wild number, but call him anyway. Coming up on Bloomberg Television and Radio later today, Intel CEO Pat Gelsinger in the 12 o'clock hour. He'll be talking after Intel results came out much better than expected, seeming to have troughed out after several quarters of losses. We're also going to be kicking off with the market open. Jonathan Ferro on Bloomberg Television, on Radio. Bloomberg surveillance does continue as we chart toward what we have with increasing data dependence, strategic ambiguity, the trifecta of central bankers.
The names that move markets are on Bloomberg.
China has seen slower growth than they expected. Many countries do depend on strong Chinese growth to promote growth in their own economies. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think we're in a good path.
Nobody covers business like Bloomberg, your global business authority. From the world of politics,
we're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come. I'm willing to have this battle.
It is vitally important. This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
This is Bloomberg.
Let's get you all to the weekend. Live from New York City this morning. Good morning, good morning. Your equity market on the week, pretty flat on the session, pushing higher on the S&P by 0.7%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York, coming up, the Bank of Japan shaking up the global bond market. As Lagarde oversees a stagnating German economy, Chairman Powell can point to robust growth in America. We begin with the big issue, wrapping up a central bank triple header.
It's certainly a big week.
The Fed moved 25.
The Fed and the ECB. She's doing exactly very, very close to what Powell's doing.
They didn't want to convey accidentally anything dovish.
Being extremely cautious, being pragmatic.
All central banks have have the same problem. We were not surprised.
It was exactly on expectations.
We almost got to the end of the week with expectations for what central banks were going to do.
The BOJ with a surprise move.
The Bank of Japan are tinkerers.
The Fed and even the ECB, I think they're going to take a backseat.
Central bankers know that markets have a tendency to get carried away. If I'm Chair Powell, I permanently have my fingers crossed behind my back.
Joining us now to discuss Amundi's Monica Defend and Morgan Stanley's Jim Caron. Monica, first to you, it's a hike from the ECB, a hike from the Federal Reserve, and a tweak to yield curve control at the BOJ. Can I just ask you how you responded this morning when you saw those headlines? Just what has the BOJ done this morning?
Well, actually, probably the Bank of Japan was the only bank yesterday that was making something different from what most of market participants were expecting. Having said that, for all the three banks, it is important to understand what comes next, because starting from the BOJ, will the central banks continue to defend the cap to 1% with unlimited purchases, or this will be breakable? And this is what I think the market is asking today.
So, Jim, do you perceive this as the starting gun on a tightening cycle, that the next step from here is maybe an interest rate hike next year? Or is this just about setting up policy in a more sustainable way to keep it easier for longer?
Yeah, listen, I think this is the first step on a very slow, long walk. So I think that what the significance here is that global bond yields have lost their anchor to some degree. We can always count on JGB yields to be relatively low and the Bank of Japan to be easy. And this is the first signal that they're going to start tightening policy. And we have to think about this as a tightening, but from the back end first. And it's almost like a LIFO, last in, first out, where yield curve control was one of the last measures that they used, and now they're starting to unwind that. So even though this is a really small tweak, and I really believe it's a tweak, it sends a really loud signal that the Bank of Japan is now going to start tightening policy, but they don't want to create like a taper tantrum, like 2013 taper tantrum, which is, Ben Bernanke and the Fed and what happened there. They want to make sure it's a very, very controlled, slow leak towards higher yields and normalizing policy rates.
If you are just tuning in, the BOJ has what's called yield curve control. There's a target of 0%. There's a ceiling of 0.5%, and we're being told by the BOJ and Governor Ueda that ultimately that 0.5% ceiling is now what's called a reference point, and that they can come into the market every single day and buy 10-year yields at, say, 1%. This is what Governor Ueda had to say. The decision to tweak the YCC is not a step towards normalization, but, Mike McKee, the aim is to enhance the sustainability of the monetary easing. Now, Mike, that's what he says it is. What is it?
It is a tweak. I think Jim is right here. They are moving in the direction they want to go, which is to get rid of yield curve control. But it's going to be very difficult to do because the markets are so used to it at this point. And if they think the bank is getting out of it, they're going to be selling off. The yellow line there is where they were in 2016 after they introduced the idea of extremely low rates and yield curve control. And everything up through 10 years was below zero. Now they went to this yield curve control where they would allow the 10-year to go up by agreeing to buy at 0.5 percentage point, bring it up below zero. Now they're going to allow it at 1%. So slowly we'll see the yield curve start to creep up there. And I think that's what they want to do is move it very, very slowly. The central banks in general, you were talking about the idea of them maybe getting close to the end. The data we got from the Fed today certainly suggests that, with basically inflation moving in the right directions. And you can see how at the end of this week, with the exception of the Bank of England, the top white line there, which doesn't meet until next week, everybody has moved a little bit closer to their end point. The Fed is now just one move away if they actually get there. The Bank of Japan is within 10 basis points of doing that, and the ECB is very close as well. So by the end of this year, we could see everybody in pause mode. They seem to be getting closer and closer to that.
Mike, thank you. The latest on the central bank decisions this week: hikes from the ECB and the Federal Reserve, tweaks from the Bank of Japan overnight. Monica, you put it all together. Is that bullish or bearish for bonds right now?
Well, it should be bullish for bonds. Actually, we've been positioning more constructively on duration, both on the U.S. and on the euro curve. We think that approaching the peak, then the ECB is clearly data dependent, but even they have, also if they have 25 basis points in September, this really doesn't make a big difference at this stage. The other side of the coin will be on the risky asset. What does it mean, and whether a slowdown eventually in the economy will kick in. Eventually, we also saw very good data out of the U.S. economy with the release of the second quarter. Despite real consumption is slowing down, it is still positive, 1.6 year on year, but is slowing. So this is really something we'll need to think about to rethink the positioning along the remainder of the year.
You think the ECB and the Federal Reserve is basically done here? Jim, you take a subtly different view, I would say, a little more nuanced. You think bonds are at risk still? Jim, tell me more.
Yeah, look, I mean, I think central banks are still keeping the door wide open for rate hikes and being very, very data dependent in terms of being concerned about inflation. And if they see it, they're going to act. And one of the points that I like to make is that, for the ECB, for example, people are starting to count them out and say, look, they might have one more hike and that's it. But I kind of take a different view on that. I think the ECB, out of all the central banks, has to get the inflation problems solved. And that's because of the structural rigidities in the European labor markets. So what Europe is starting to experience right now is a small form, just the beginning stages of possibly wage price spiral inflation, meaning that you see a lot of strikes in Europe, people are getting higher wages, companies are able to increase their prices, people get higher wages, and on and on and on. And that's a spiral. So I think that it's more likely that the ECB can overshoot. Now, to that point, and same with the Fed, I think the Fed is also very, very concerned about keeping inflation anchored. So to that point, I think that whether it's Powell or it's Lagarde at the ECB, I think that the door is still wide open for them to continue to hike interest rates. So I think front-end yields can be somewhat at risk. Curves are likely to stay inverted. Not until they start steepening will I believe that the end of the rate hiking cycle is really here.
Jim, would you expect to see some divergence between government bond markets in Europe, in the United States, based on the information you're seeing so far? The French GDP data, and we'll talk about it later, was okay. Germany's terrible. The PMIs earlier this week, not great at all. I just got this note from Bank of America, Mike Gaitman and the team, and the headline reads, "If this is a slowdown, please give us more." Because the data in America, Jim, has been pretty decent through the week. Could we get some divergence between government bond markets?
Absolutely. Look, I mean, I think that the data is even diverging to some degree. And the way that I've looked at the U.S. versus Europe since the pandemic is that the U.S. has been running about 3 or 4 months ahead of Europe in terms of the cyclical data and the turning points and central bank policy and inflation and things like that. So I think that the surge that we're seeing in the U.S. right now, this late cycle surge, Europe might actually see that too. And I also think that PMIs, particularly in the U.S., are bottoming at this point, and that they're going to move more towards services as opposed to services moving to PMIs.
Wow.
Services moving to manufacturing. And I think that that's going to happen in Europe as well, but it might not be until the early part of next year.
Jim, thank you, buddy. You're going to stick with us. Jim Karen, Monica Defend on the latest economic data as well. We'll talk about that in Europe in just a moment. Just bear that in mind, that in the United States, and in Europe for that matter as well, the theme has been that services have been up here, pretty decent data, manufacturing down here, pretty ugly. And a conversation we've been having, how do they converge? Services down to manufacturing or manufacturing up to services? Jay Pilowsky at TBW earlier this morning on Bloomberg Surveillance suggesting it's in the more constructive way. Manufacturing recovers, and you're hearing something similar from Jim Karen there. Your equity market right now on the S&P 500 positive by 0.7%. The opening bell about 20 minutes away. Down in Washington, some breaking news in the last, I would say, 5 or 10 minutes. I want to head down to Bloomberg's Anne-Marie to get those headlines for you. Anne-Marie, what's the latest?
What we know is Senator Mitch McConnell plans to stay on as the Senate Minority Leader to lead the Republicans on the Senate side. Jonathan, there's been a lot of speculation and concern regarding his health. Remember, he had a concussion. He was out for a few months. He came back, and then yesterday, while on camera, while speaking to reporters, having this press conference, he froze for 20 seconds, and he was lost for words, and he was escorted away. Then he did come back and address reporters, and then later when he spoke to reporters, he did a very political, interesting maneuver, turning it on the Democrats, saying their president of the United States also dealing with potentially some issues. He said, the president called me, I told him I was in great health, but that I got sandbagged. So what we're learning from CNN, Jonathan, is he plans to serve the rest of the 118th Congress as the GOP leader. The one thing that's interesting about this statement that CNN is publishing is that the statement does not address his plans in the next Congress, which begins in 2025. He is still going to be an elected official from Kentucky at that time, but the statement does not address his plans for 2025. So this is certainly one that we'll be watching.
AMH, thank you. We'll be watching that through this morning as well. We'll touch base with you in about 30 minutes' time. The president addressing the United States on the economy and economic policy a little bit later on this afternoon. We'll get you a preview of that a little bit later. Equities then higher on both the S&P and on the NASDAQ with some movers. Here's Abby.
John, let's take a look at some of the upside movers helping futures climb this morning after yesterday's bit of a drop. Intel up the last time I looked up more than 6%. They put up a profit, 6.7%. They put up a profit instead of a loss in the last quarter, a 3% revenue beat. The biggest deal, though, is that they are saying the PC slump, the personal PC slump is over, and the second half should be better. And and they gave a bullish guide for the current quarter. Advanced Micro Devices up 1.7%. Now, they're a competitor, of course, to Intel. They report next Tuesday, but they're getting a little bit of a sympathy lift here. Plus, they did announce today that they're making a $400 million investment in India. And then finally, Reata Pharmaceuticals absolutely soaring, up 52%. The biopharma firm is soaring on Biogen taking it over, a bid at $7.3 billion. It will bolster its portfolio of treatments for neuromuscular and rare diseases. The share price, $172.50. The stock not so far below it, suggesting investors think it may get done.
Abby, thanks for that. We'll touch base with you around the opening bell. Coming up, more signs of economic divergence.
Inflation has been high everywhere, including US and Euro area, but really the primary drivers have been quite different. In the US, it's really coming from a very strong domestic economy. It's just more of a challenge in the Euro area to get us back to a steady state.
That conversation up next.
I don't think we can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
From New York City.
From London. In Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
The near-term economic outlook for the euro area has deteriorated, owing largely to weaker domestic demand. High inflation and tighter financing conditions are dampening spending.
The broader picture of what we want to see is we want to see easing of supply constraints and normalization of pandemic-related distortions to demand and supply. We want to see economic growth running at moderate or modest levels to help ease inflationary pressures.
It is a tale of two recoveries, US inflation cooling and consumers remaining resilient, adding to momentum in the economy ahead of the third quarter. This as the data continues to raise concerns over in Europe. Germany just about exiting recession, but its outlook remains gloomy and manufacturing weak. Let's get to the team coverage. Bloomberg's Ender Curran in DC alongside Maria Tadeo in Brussels. Maria, how mixed are things in the Eurozone economy right now?
Well, they are, and that's a challenge for a central bank that obviously has to set monetary policy for 20 different economies. And I think you see that today in the data that we got from both Germany and France. These are the two biggest economies, so obviously we really look at them in detail. You had a huge beat from the French economy for Q2. You also had inflation, by the way, cooling down the most since the war started. When you look at the German situation, they're out of a technical recession at this point, but the outlook continues to be very, very difficult for this economy. A lot of this because of the industry and just this perfect storm that they've had for a year now. Also, I should also stress the data that we got today, and again, it points to this divergence perhaps between a more service economy and a more industrial economy. It is backwards looking. So we know that the European Central Bank will focus on the data from now until September. We also had a taste of it yesterday with Madame Lagarde saying there is an outlook that could probably deteriorate in the next few months. So that is really going to weigh in on this. So the data today, yes, to set the scene, but will it be crucial for the European Central Bank going into September? Probably not. They want to look into the future.
It's pretty mixed over in Europe right now. Endra, I have to say in the United States, it looks pretty robust, doesn't it?
Yeah, the US was supposed to be in a recession by now, John. That was the narrative back in January. But as you know, the numbers keep coming in pretty well. GDP data yesterday showing pretty decent pace of growth for the economy. Underlying that, we know consumer spending is holding up. We know inflation is headed in the right direction. We saw some more detail on that this morning with the wages data showing increases just coming off moderately there. We know that investment in manufacturing is going gangbusters. There are, of course, soft patches within manufacturing, but the electronic vehicle space and battery space and the whole industrial policy story is driving a lot of demand there. And so we know the US economy is in good order. That said, though, you know, there's a risk of getting too giddy about it in some respects as well, John, because the months ahead will tell just how far the labour market.
Powell and President Lagarde might sound the same, but the underlying economies are very, very different right now. Jim Karen, this came from Capital Economics moments ago. It said Q2 resilience unlikely to last, talking about Europe, but inflation is here to stay high. Now, Jim, why aren't we talking about stagflation in Europe when that's what increasingly it looks like?
I think that's the direction that we're headed in, effectively, right? So the ECB is in a very, very difficult position where they have some of the traditional economic data starting to fall, but inflation is staying sticky. And this is what I was referring to before, where there are different structural rigidities within Europe that are different than what's in the U.S. And I think a lot of it has to do with labor and the labor force. So the U.S. labor force tends to be a little bit more dynamic and robust. U.S. companies can upsize and downsize labor as needed relative to the economic cycle. In Europe, they have a lot more difficulty doing that. So as wage prices go up, that's like a form of permanence. If the economy starts to turn down, that starts to squeeze profit margins in companies, and this just becomes a lot more of a difficult situation for the European economy as a whole. So I do think that we are heading into some stagflationary pressures in the euro area. We also have to recognize that Europe is also tied a little bit more to China in terms of their economic activity versus the U.S. So those factors, the structural rigidities, the tied levels to China, are differences between the Eurozone economy and the U.S. economy.
Monica, Chairman Powell is hoping for a soft landing. Are there reasons to hope that President Lagarde doesn't end up in some kind of stagflationary quagmire?
Well, the U.S. economy has been extremely resilient and definitely well above our expectations. And even also the corporate earnings, despite variable, has been quite robust and resilient. And all the profit margin squeeze that we were expecting actually did not materialize, if not on specific sectors. So when it goes to our own projection, we expect the U.S. economy to slow down, mainly via tightening financing conditions that have not been reflected fully yet in the real economy, but should eventually hamper the U.S. consumers that, as I was saying before, still with a positive sign, but real consumption is slowing down in the last over the second quarter, and the tighter financing conditions should also eventually hurt the small and medium enterprises. So overall, there will be a slowdown. How deep and when it will start to mark a recession that is still open. But the soft landing scenario is what we have in mind right now.
Jim, just to finish on Europe, if you end up in some kind of stagflationary state, how do bonds trade against that, Jim? Is that good or bad?
Well, I think it's more of a shape of the yield curve story. So what it tells you is that the curve probably stays relatively inverted, which is not good for the financial sector or the banks, because the ECB probably has to continue to hike rates, and that's going to put pressure on the front end. But then the markets are basically going to say, yeah, but eventually we're going to have a slowdown in a recession, and it's going to be a little bit longer lasting. So longer term bond yields end up staying relatively well bid and with lower yields. So you end up with an inverted yield curve, which is generally not a good economic indicator for the future. And that probably also, heightens some of the risk of a slowdown.
Hey, Jim, thank you. Jim Karen, alongside Monica Defend there on the latest in this market. The central bank trilogy of the week, the BOJ, the ECB, the Federal Reserve. We need to talk about this equity market, up today by 0.7%. Coming up, the morning calls and later, New Edge Wealth's Cameron Dawson saying the market's AI obsession is starting to crack. The opportunities outside of big tech, that conversation about 7 minutes away.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Minutes away from the opening bow. Look at that move on the Nasdaq. Futures up, up, up and away. Firmer here. Let's get you some morning calls. Deutsche Bank downgrading Southwest to hold, expecting limited upside following the airline's quarterly results. JP Morgan upgrading New York Community Bank to overweight, seeing an attractive risk reward with growing market share gains. That stock is up by 3.4%. And finally, Bank of America upgrading First Solar to buy, highlighting solid bookings momentum and the company's improving execution. That stock is up by almost 13% in early trading. Up next on this program, New Edge Wealth's Cameron Dawson expecting the equity rally to start broadening out. The case for looking outside of big tech coming up very shortly. Your equity market positive by 0.66% on the S&P 500 and the Nasdaq 100 a whole lot higher. The opening bell just around the corner.
crucially important. And I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg.
Three seconds away from the opening bow this morning, this Friday, getting you towards the weekend. Your equity market positive by 0.7% on the S&P, on the Nasdaq up by more than 1%. About a week away, some big earnings from Apple and Amazon after some pretty big gains so far year to date. There's the opening bow this Friday morning. Good morning. Switch at the board and get to the bond market. Yields look like this on a 10-year, lower by a couple of basis points. Your 10-year this morning, 397.46. Yields higher yesterday off the back of better than expected economic data. And the rumour mill in full drive after that Nikkei report suggesting the BOJ would do exactly what it would do, which was tweak yield curve control. This morning, yields pulled back in the FX market. The euro trying to find some strength, just about 110 right now. Euro dollar positive 0.2%. Crude just short of 80, $79.60, down 50 cents on the session. We're down 0.6%. About 30 seconds into this session right now, your equity market more broadly on the S&P 500 advancing 0.7%. On the Nasdaq, up by 1 percentage point. Two stocks to watch at the open, Exxon and Chevron. Shares under pressure after posting monster declines in quarterly profit. The Exxon CEO saying this: the work we've been doing to improve our profitability is reflected in our results, which doubled from what we earned just 5 years ago. Abby has more. Hey, Abby.
Well, John, their profit, though, is down 50% from a year ago, so I think that that's what's probably worrying investors to some degree. It's interesting, though, to see the shares of Chevron trading lower than Exxon, given the fact that they beat both top and bottom line estimates. Exxon did beat revenue estimates, but their profit, not only was it down 50% year over year, it missed slightly. So this is a margin problem. Both of these companies, or at least Exxon, is talking about the possibility, or not the possibility, the actuality of downstream or refining margin pressures, that it's costing more. Now, it's interesting because the conference call is going on, and one analyst asked the CFO about the upstream, could there be the fourth quarter?
And let's stick with results. Intel delivers a surprise profit and bullish forecast. The CEO says we continue to execute on our strategic priorities and building momentum with our businesses. Katie Greifeld has more. Hey, Katie.
Hey, John. Yeah, well, Intel declared an end to the slump in personal computers demand, and actually it has the numbers to back it up. It was a beat and raise quarter for this chip maker. It posted a surprise profit, and it paired that with a bullish sales forecast that topped analyst estimates. Specifically, sales in the third quarter expected to come in as much as $13.9 billion. That compares to an average analyst estimate of about $13.3 billion, so higher than expectations. And Intel really needed this, given that the sluggish demands for PC chips up until this point, it really battered the business over the past year or so. And you add in CEO Pat Gelsinger's comments that Intel remains on track to meet its target of regaining manufacturing leadership by 2025. And you can see that shares currently up about 4% at this moment, had been higher by as much as 8% pre-market.
Katie, thanks for that. The stock is higher, as Katie indicated. Let's turn to Ford, pushing back plans to ramp up its EV production. The CEO, Jim Farley, telling analysts, clearly this transition to EVs is dynamic. The pricing pressure has dramatically increased in just the last 60 days. Ed Ludlow has more. Morning, Ed.
Yeah, good morning, Jonathan. There's a lot of data to pass, but the story is pretty clear. The losses from EVs are deepening, and the timeline to ramping up production to higher volumes is getting more distant. So losses this year for the EV business will now be $4.5 billion US. They had previously said it would be $3 billion. Model E, the unit which manufactures the electric vehicles as a standalone business, had a loss of $1.08 billion in the quarter just gone. The other data point is that Ford's aim of an annual production of 600,000 units battery electric will not happen in 2023. They are now saying it will happen in 2024. So they're pushing that timeline out. Pricing is a really key point here. What Ford is saying is that the first wave of early adopters is gone. They have their EVs, and the average consumer is not willing to pay that higher price point. That's what the CFO, John Lawler, was talking about, them not seeing the top-line growth in electric vehicles that perhaps they'd expected. So what do we see? Well, a lot of price pressure, and a lot of the intensity of that price pressure, according to Jim Farley, the CEO, has come in just the last 60 days, cutting prices to be more competitive against Tesla. Interestingly, though, the broader business is quite healthy, and this was the headline immediately after the market closed when the numbers dropped. They raised guidance for adjusted EBIT this year higher because, of course, they still have the legacy combustion engine business, and there is demand there and performance there as well.
Did we hear the same thing from GM?
Yeah, it's interesting. You look at the sell-side reaction to Ford, and they said the bar for Ford going into this was so high because of the results that GM posted. But both of them are in the same boat, right? Transitioning the business from a combustion engine to EV, selling both, but also having to cut prices to basically target what is the remaining demand. The early adopters are gone. The average American or global consumer doesn't want to pay $75,000 for a car.
And that stock's down by 3%. Let's push ahead to next week. I know you're covering earnings from the likes of the big tech players, Apple, Amazon as well. What are you looking for from those names next week?
Well, I'm also kind of smiling at relief that they're not all on the same day this quarter, because that can be brutal for me. But I think that we basically want to use them as a proxy for the consumer. You know, Prime Day for Amazon is always a bit of a misleading indicator because they always break their own record. But it doesn't give you a good sense of the health of that business. Also, cloud gives you the barometer for corporate demand and corporate spending. AI is a big part of that story. Apple, maybe we get some early indication of the Vision Pro, but it's all about the iPhone globally and some sense of what the global consumer is doing with a microscope on China, John.
Ed, if you had to grade it so far, looking at Meta, looking at Alphabet, it's been a pretty good week, hasn't it?
Been a pretty good week, but read Alex Barinka's Tech Daily newsletter. AI is all the hype we're talking about. You actually look at the reaction on the sell side, some of the buying. I think that actually there's still a lot of faith in the fundamentals of these businesses. Strong balance sheets, demand for their product or services, even in a weaker economic environment. They have staying power because of what they're able to offer and their global reach.
Looking forward to the show a little bit later, 12 Eastern Time. Ed Ludlow alongside Caroline Hyde on Bloomberg Technology. Let's turn back to the market. Big tech leading stocks towards a third consecutive week of gains. Our next guest, though, says it could be the laggards that start leading the way. New Edge Wealth's Cameron Dawson saying this: we're seeing the everything else rally. Better economic growth should mean broader participation, especially from the economically sensitive sectors that have been left behind. I'm pleased to say that Cameron Dawson joins us now. So Cameron, let's start there. What has been
economic data, we would expect broader participation in the equity rally, meaning that those areas that are cyclically sensitive should start to do better. And it also is important to point out that these are the areas that have seen the least amount of PE expansion or multiple expansion. So there's more room for those multiples to adjust to a better economic reality compared to the technology stocks and growth stocks that have already re-rated back up to their 2021 peaks.
As you indicated, the economic data has improved. Cameron, any evidence that earnings estimates have gone along with it?
This has been really peculiar this quarter, is that we continue to see economic data come in better than expected. We see it with economic surprises. We see companies beat and raise estimates. And yet, if you look at the full year estimate for 2023 earnings, they have inched down just slightly, which means that analysts are effectively cutting numbers for the back half of the year. So that does create a scenario where we have a low bar for earnings in the back half of 2023. But then we'd know is that what that also creates is even more growth expected in 2024. You have about 11-12% growth already baked in for 2024. And a lot of that is margin expansion, which would bring you back to peak margins back that we saw back in 2021. So that's one area where we would watch that maybe estimates are a little bit too high. But in the near term, it does seem that estimates are too low for the economic reality.
Just on pricing power, just briefly, Kimberly-Clark, Procter & Gamble, volumes dropping off, but revenue growth because prices are able to increase and the tolerance still seems to be there. Do you expect that consumer price tolerance to last much longer?
Well, it is a really good question because as we continue to see kind of stronger goods demand as well, look at the personal consumption data today. Instead of it being led by services, it was actually led by goods. Goods were much stronger than services, even despite this turn in higher prices. So for now, consumers are accepting it. We're seeing a little bit of give back on volume, but Procter & Gamble this morning raised prices by 9% and only had volumes drop by 3%. That's pretty incredible and is a key reason why margins have been so resilient for these businesses and why revenue growth has remained so strong.
About 10 minutes into the session, the Nasdaq outperforming. We're advancing here by 1.2% on the Nasdaq. If you are just tuning in, the S&P 500 higher by 0.75%. Cameron, I remember a note that you put out in the last couple of weeks, and it was bull, bear, or duck. For the people that haven't read that, haven't heard you talk about it, what is a duck?
A duck is a market that goes sideways, but there's a lot of activity happening under the surface, meaning that if we do see this rotation away from some of the leaders this year, this idea that maybe tech digests some of its recent gains as it hits that peak in valuation, but you do see a recovery in some of these areas that have been left behind, those rotations under the surface could mean that there's lots of opportunity beginning of June, buying equal weight, looking for areas that are trading at discounts in order to take advantage of the rotation. So a duck market seems smooth on the surface, but lots of activity underneath.
Where do the small caps fit into that?
Small caps are still extraordinarily sensitive to interest rates. I think that this is one of the key headwinds for small caps is that they are less profitable. You still have about 45% of companies within the small cap Russell 2000 index still not turning a profit, even in this economic environment. And they tend to have more floating rate debt, which just means that higher interest rates actually bite small caps compared to large cap companies, which have had the opportunity to term out their debt, essentially make them agnostic to current interest rate levels and really being able to be resilient even in an economy where you see the Fed raising rates so much. So our view on small caps is that you see these pockets and spikes of recovery, but you're unlikely to see a sustained rally and sustained period of outperformance until we start the next cycle, which just means that small caps typically do best at the beginning of an economic cycle when the Fed is easing policy rapidly and they're kind of rebounding from that near death as you went into the recession. So small caps, we think you still have to remain very high quality simply because of high interest rates and that economic sensitivity.
Hey, Cameron, thanks for that. Enjoy the weekend. Let's catch up soon. Cameron Dawson there of New Edge on the latest. Thank you. The broader market about 12 minutes into the session, advancing by 0.8% on the S&P. Nice, pretty decent outperformance on the Nasdaq going into a big week for the Nasdaq 100. Some big weightings there for you. Apple and Amazon next Thursday. Up next on this program, the president promoting his economic agenda ahead of next week's jobs report.
There are two parts to Bidenomics. The first part is just explaining what's going on and claiming credit for what is a pretty strong economy, inflation aside, and that's a big aside. The second part about Bidenomics is to talk about some of the president's legislative achievements.
The president heading to Maine to discuss Bidenomics. That conversation up next. We'll catch up with Anne-Marie and Mike McKee.
The names that move markets are on Bloomberg.
China has seen slower growth than they expected. Many countries do depend on strong Chinese growth to promote growth in their own economies. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think we're in a good path.
Nobody covers business like Bloomberg, your global business authority.
Global economic pain may turn into emerging markets gain. Investors say they plan to allocate more funds to emerging markets over the next year. That's according to the latest Bloomberg survey of professional and retail investors. More than 60% of respondents are betting emerging markets will either push higher or outperform the developed markets if the U.S. economy tips into recession. This would mark a significant change in leadership that's been in place for more than a decade, in which U.S. stocks have returned more than 700% since March 2009, dominating the rest of the world. Within EM, market watchers rank stocks as the best investment, followed by a tie between debt and local currencies and U.S. dollars. Lower valuations is a big draw. In equities, the MSCI Emerging Market Index trades at 12.5 times estimated 2023 earnings. By contrast, the S&P 500 has a multiple of more than 18.5. External factors may end up proving to be bigger influences on emerging markets than domestic politics. The dollar's weakening trend means companies in emerging markets should have more room for growth, and countries that did not prop up their economies with stimulus during the pandemic may be better positioned to return to a growth rate that's sustainable. Looking out over the next 2 years, respondents overwhelmingly made Southeast Asia their top pick, beating out Latin America and Eastern Europe by a wide margin.
Three prime ministers, 4 chancellors, an energy crisis, and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
There are two parts to Bidenomics. The first part is just explaining what's going on and claiming credit for what is a pretty strong economy, inflation aside, and that's a big aside. The second part about Bidenomics is to talk about some of the president's legislative achievements, which collectively amount to this big pro-growth agenda that he got through a divided Congress. So it's both about claiming credit and then explaining sort of the rationale for all the legislations.
Everything's been amazing, inflation aside, as he said. That's a big aside. President Biden preparing to discuss his economic agenda following a string of better-than-expected data. The White House saying this. The president will discuss how Bidenomics is driving a manufacturing boom and helping workers and innovators invent and make more in America. Bloomberg's Anne-Marie has more. Hey, Anne-Marie.
Hey, John. Well, today you can expect a fresh installment of Bidenomics with a focus, as you mentioned, on manufacturing. For the first time in his presidency, the Biden will be heading to Maine. He'll be giving this speech on manufacturing at a factory, and his message is going to be behind those strong economic data points is that his plans are working. One of those points he's likely going to mention today is that investment in manufacturing construction has had its single largest contribution to the nation's economic growth in more than 4 decades. The issue the president is facing, Jonathan, and we talk about this a lot, and actually our reporting is that he's been frustrated with aides around him, is that the message is not landing. The American people are still not feeling that the economy around them, even if the data is showing that it is doing better, that it actually is doing better. They can't feel it. So that's the message the president wants to bring to Maine today. Another interesting point, Jonathan, about this factory, it recently won a legal battle with a China. So broadly, Biden is also potentially going to talk about competition with China and how that plays into his larger economic plan.
Any sign that's resonating with voters, Anne-Marie?
Well, I'm not sure that's resonating with voters at the moment because we're here from both sides of the aisle that everyone wants to talk tough on China, right, Jonathan? So I think voters get it from all sides when it comes to China. I think it's really going to come down to how people feel about their household income, about their disposable income, about their job and growth prospects when it comes down to November in 2024. I think they're less focused on competition with China and more focused on how much am I paying for groceries and what's the gasoline price today?
And that gasoline price is going the wrong way all over again, more recently anyway.
Yeah.
Anne-Marie, thank you. AMH down in Washington, D.C. That address by the president, 1:15 Eastern time. If you want to pay some attention to that, we will be here at Bloomberg. Looking ahead to next week, a payrolls report just around the corner. Mike McKee back with us for more. Mike, what can we expect?
Well, it's going to be a very busy week, Jonathan. It's the first week of the month, and that's always the week we get the big numbers. We start off with one last day of July, and we get the Senior Loan Officer Survey on Monday. Remember that? The Fed chairman talked about it. He said it's going to come in as expected, so we think there'll be some tightening there. Tuesday, you've got ISM manufacturing and JOLTS. Wednesday's ADP. Thursday, productivity, jobless claims, ISM services, and then Friday is Jobs Day. And in terms of the Jobs Day numbers, we are expecting a slowdown. We've been expecting a slowdown for months and months and months, and it doesn't seem to happen. 190,000 jobs is the forecast at the moment. That'll change as we go through these numbers next week, and economists get a better view of what's happening. But unemployment not supposed to go up, and average hourly earnings supposed to go down just a little bit. So if Joe Biden were giving this speech and we got these numbers a week from now, he'd still have some good news to talk about, and we'll see if that is indeed the case.
I imagine he won't be talking about the ISM Services Index, Mike. Wall Street will be. There is a survey of services activity next week. Mike, Jim Karen of Morgan Stanley was on the program earlier this morning, and he was talking about that divergence, the divide that we talk about, you and I, between manufacturing and services, and he thinks the manufacturing can converge up to services. What are you seeing more recently in those surveys?
Well, what we saw last week or earlier this week, the S&P PMIs, manufacturing did improve a little bit. Services did decline a little bit, but services are still above 50. So if manufacturing moves up to where services are in the ISM version of these PMIs, then it's going to be good news for the economy. And I think we pointed out earlier on the show that goods spending was faster than services spending in the month of June. So maybe things are turning around a little bit.
Very little sign of Fed speak on the calendar, Mike. Have you noticed that?
It's just beginning to fill
Starting
in.
to come through.
We're going to hear on Monday from Raphael Bostic and later in the week from Tom Barkin. And so I imagine it will pick up, but they're all going to go on vacation. Wait till Jackson Hole. That's when we'll
That's
hear
what we
from
should
a
do,
lot.
Mike. We'll take a month off and we'll reconvene.
I'd like that.
Jackson Hole,
You'd
I'd love
talk
that
to the
too.
boss about that.
I'd love that too. TK's going to cover. Tom's very adamant about the American philosophy of work and no vacation, so TK's going to be here, taking over things. Mike McKee, thank you. Looking ahead to the Senior Loan Officer Opinion Survey, SLOOS, a sign of its time, really, in many ways. It's like the inflation hysteria of the last couple of years. Hysteria because it was legitimate. Let's be clear about that. But also the fact we were looking at Mitch, inflation expectations during that time, and now we're not really. And the Senior Loan Officer Opinion Survey, well, that was all about the bank intention of 2-3 months ago, and now hardly anyone's paying attention to it. It comes out, as Mike indicated, on Monday, by the way. Let's get you some sector price action. We can do that with Abby.
John, we have a very robust day for the S&P 500, the best in basically a month. So not surprisingly, most sectors are higher, led, in fact, by the heavyweight tech sectors, communication services, consumer discretionary, information technology, all up more than 1%. We also have staples, a defensive sector, interestingly enough, up more than 1%. to the downside. Energy and healthcare. Energy, of course, dragged on by Chevron and Exxon. As for the week, well, it's going to depend on today. Basically, what today does will determine the S&P 500's direction. So right now, we are looking at a gain. The best sector right there, the communication services index, up 6.5%. Its best week since March 17th, of course, on Alphabet and Meta and those blowout results and the stocks reacting to the upside.
Happy, thank you. Advancing again this morning. Your trading diary up next.
Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
The sun is shining on this economy, this market right now, that's for sure. The data's been decent, the earnings have been okay. Chairman Powell appears to give the impression that he's willing to back away. And equities are up by another 0.8% on the S&P. The Nasdaq's positive by 1.5%. Next week, huge week for earnings. We'll talk about that in just a moment. That's the price action. Let's get to the trading diary. President Biden promoting his economic agenda from Maine this afternoon at 1:15 Eastern Time. Then we get ISM manufacturing numbers next Tuesday. More tech earnings from Qualcomm on Wednesday, Apple and Amazon earning results on Thursday, plus ISM services and a Bank of England rate decision coming up a little bit later next week too. And finally, the US payrolls report this time next week on Friday. From New York City, that does it for me. Enjoy the weekend. This was the countdown to the open. Good luck for the rest of the trading day. This is Bloomberg.
I don't think we can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but XPeng is XPeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
The names that move markets are on Bloomberg.
Concentration in industry after industry after industry is a threat to our economy. It is a threat to innovation, and ultimately often leads to price gouging, whether it's consumers or the government. I believe in the power of markets, but they only work if we enforce the rules that keep competitors going rather than monopolists.
Nobody covers business like Bloomberg, your global business authority.
DOJ or other authorities
could face bigger challenges next.
Was going to keep rate while
This is a 3 as the economic picture does. The BOK is getting ready to make a decision.
This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
Good Friday morning from the Bloomberg Interactive Brokers studio in New York City to our worldwide audience. Green on the screen, the S&P 500 up 0.8%. We're going to kick it off talking about global oil. We got WTI crude oil near $80 a barrel. I want to know what's going on, so I'm going to check in with Mike McGlone and Fernando Valle. They cover all the energy complex for Bloomberg Intelligence. They're going to join me and Matt coming up in just moments. Plus, it's Friday. And Matt forgot, but Friday in Bloomberg Markets, because he's been away for so many months, Friday on Bloomberg Markets is Municipal Bond Friday.
Oh,
so we
God,
municipal
munis.
Bond market again. How
I'm
good
excited.
is that?
Joe Mysak?
No, we're going to do Eric Kazatsky.
Eric
today from
Kazatsky,
Bloomberg
okay.
Intelligence. So we're going to be just a stellar discussion on the municipal bond markets. But first, let's kick things off with John Tucker.
All right, a lot of data today, Matt and Paul. Just out the University of Michigan, the sentiment survey coming in a little lighter than expected, 71.6. I go right, in fact, to the inflation expectations. 1 year inflation expectation, 3.4%. That's exactly the same that we saw last month. A little longer term, the 10-year inflation expectation coming in at 3%. You'll recall the last survey, it was at 3.1%, so a little better there. The reason we care about the inflation expectations, they tend to be self-fulfilling expectations. We also got the economic data this morning. That seems to confirm the Goldilocks economy of the U.S. Not too hot, not too cold, just right. The key inflation measure continuing to cool there. That's the core PCE. Consumer spending picked up. That adds to momentum in the economy ahead of the third quarter. And Jonathan Pingle at UBS Securities reacted to this morning's data.
So this is all good news, and the economy has certainly proved resilient. But they do have this problem that we're making progress on inflation, it looks like, but we're not actually at 2 yet. And there's actually a pretty big gap between now and how we're going to get there, and a lot of uncertainty.
Right now, S&P is up 42 points, up almost 1%, 4580 on the index. The Dow up 161 points, that's up 0.5%. The NASDAQ 100 right now, 251 points. Sales and earnings both surpassing analyst estimates. So it was $3.76 a gallon this morning, Paul, at the Wawa.
All right.
In
Route
New Jersey.
36.
So no, it's starting to hurt.
I know. Plus, I mean, your commuting costs are just ridiculous. You have
He
to
pays
pay
all the tolls himself.
I know.
I would charge those to the company.
Oh, of course I would.
You got to expense that.
You're gonna change company policy on the air?
I think the
didn't
policy
know.
is
Am I
if you come
missing
in
out?
between 9 p.m. and 6 a.m., you get to charge that stuff to the company. And I believe you come in at what time do you come in?
I'm on the road at 3:30.
So
like that.
That's just no good. That's
Pretty
no
good
way
deal
to
for
live
me.
your life. All right, John Tucker, thank you so much. We appreciate it. Matt Miller, Paul Sweeney here with you in the Bloomberg Interactive Broker Studio. We are streaming on that internet thing. Just head over to YouTube and search Bloomberg Global News, and that's where you will find us. Nice start to the Friday trading session, up 0.9% in the S&P 500. We had some good numbers last night out of some tech names led by Intel, so that's always good news. Let's check in with Emily Graffeo. She covers the markets for Bloomberg News. She joins us here in our Bloomberg Interactive Broker Studio. Emily, what are you looking at today?
Well, I mean, Intel's up about 5% right now. They reported a profit in the second quarter, and they gave a bullish sales forecast that topped analyst estimates. So they see revenue at $12.9 billion to $13.9 billion. That beat estimates of $13.2 billion. It's interesting for Intel, though, because they are a chip maker, but I was looking at the year-to-date gain, only 31%. Now, that's not nothing, but it has underperformed the Philadelphia Stock Exchange Semi-Index, which is up 49%. And, of course, all of the big chip maker names that we think of, NVIDIA, up a lot more than Intel's.
Yeah, we were just
gain.
talking to Ed Ludlow from Bloomberg News out in San Francisco, and he's going to be interviewing the CEO of Intel at 12:10 Wall Street time today. He was saying that Intel's has not necessarily been the winner on the AI play as of yet.
They don't even mention it. It's not even in the first four graphs of the story. You know, Ed, yesterday he talked to somebody from Pacific Gas and Electric, PG&E. The headline was AI, right? Kroger comes out with earnings. The headline is AI.
8 times.
Like if Intel doesn't have AI in the top of the story, they're doing something wrong.
Yeah, right. Well, they did talk about that PC slump.
Over.
All right. Well, that's kind of feels so like last century, though.
It does
You
feel
got to be talking
really
AI.
last century.
So anyway,
But what does that even mean? People are buying personal computers right now?
People are buying more.
Yes, they are.
And their
People-
inventory has
I had the
balanced
Bloomberg Intelligence
out.
analyst. I taped it yesterday, our show for the weekend. He called it. It's turning around. People are buying stuff because they bought during the pandemic, and then they didn't buy because they had already bought everything. Now they're coming back and buying again, refreshing yet again. So it's back. It's a thing. People are buying laptops and stuff like that.
I
So
guess
what else
so.
you got for us, Emily?
Also looking at Exxon, because although there's a lot of green on the screen, that stock is down about 2% right now. Their second quarter earnings missed expectations, and they had actually already lowered the guidance a few weeks ago, talking about how lower gas prices and lower refining margins were going to hurt their earnings. And now they came out again with overall net income of only $7.9 billion. That was less than half of what we saw a year ago, kind of in line with the guidance that they shared a few weeks ago, but the shareholders this morning not liking that news. And it's interesting because we talk about falling inflation, disinflation, creating a soft landing, and how that's good for risk assets, good for the American consumer. But clearly here, it's hurting these energy names like Exxon to see lower gas prices.
But we'll see. I mean, I'm guessing in the current quarter, things are going to turn around, right? Because I'm looking at NYMEX crude trading right now at $79.88, Brent at 84.
And John Tucker just called out gasoline prices. The daily national average gasoline prices for regular.
That's just regular unleaded.
$3.73 a gallon.
If you drive Paul Sweeney's BMW, you need to be tanking with premium.
I don't. I kind of go cheap on that.
You got to put the fancy stuff
I know.
in the car.
All right. Anything else out there, Emily?
Roku. Aren't we going to hear about what's the story with Roku?
So Roku shares are rising as much as 9.3%. The net revenue was a lot stronger than expected, $847.2 million. That's up 11% from a year ago and beating estimates of just about $774 million. When I think Roku, I think of ARK. I think that's because I focus on ETFs so much. But Roku is the third top holding in Cathie Wood's ARK ETF. So we're seeing ARK also up higher today.
It's so weird because ARK, it's about like future tech, right? And Roku is what my 71-year-old mother uses, right? I mean, do the kids really use Roku?
My dad actually knows how to use the Roku TV more than I do, and he makes fun of me because I don't even know how to turn it on.
Here's an $11 billion market cap stock. 32 analysts on Wall Street cover this company. It's unbelievable. Stock's up 100%. Stock's doubled this year. So good for
do
the
they
ARK
like
group.
it? I mean,
it's kind of mixed. It's kind of mixed. So you type in
A&R?
A&R, and it's kind of mixed. People are kind of half and halves on that. So
13 buys, 14 holds, and which are pretty much sells, and 5 sells.
Yep, exactly.
It's also down a ton from its all-time highs. It was almost at $500 a share in 2021, and now it's about $81. So
you want to talk? Go type in this one, Dish. For Charlie Ergen's Dish Network. Remember those satellite dishes?
I remember you could buy like the football package on Dish, right? And that was pretty much
DirecTV. That was DirecTV.
Oh, I see.
But you look at Dish. I mean, that was one of the leading satellite companies back in the day. Now, of course, everybody has been cutting the cord, including the satellite cord. So you've got a company that had a peak stock price back in 2014 of $73 a share, $72 a share. It's now below $8 a share because that business kind of went away. So you think about Roku. Stocks doubled this year, but Dish going the other way. So anyway, there you go. That's telecommunications. That's how it works. Emily Gaffeo, thank you so much for joining us here, giving us that latest on the markets. Let's talk about WTI crude oil. Matt just called it out. We're down. We hit $80 a barrel yesterday on WTI crude. I don't know where this is coming. So let's bring in some people.
And it was fast, right? It went from 70 to 80 very quickly.
Exactly. We were below $68 now here we are at 80. Go figure. Mike McGlone, though, he knows what's going on. So does Fernando Valle. They are both analysts covering the energy space for Bloomberg Intelligence. Hey, Mike, let's start with you. You're down in balmy Miami, Florida. How is it now, tough guy?
It's actually cooler here than you are there. Your high yesterday, I think, was in the high 90s. Ours is in the low 80s. So you got to come south to cool off.
All right, buddy. How did we get here with WTI crude oil at $80 a barrel?
We were at 70 at the beginning of July. So within a month, we're up $10.
So it's looking at in the year, it's unchanged, basically. Still actually down in the year. So it's basically bouncing from getting too oversold. But look at the macro big picture. What we did last year was one of the biggest pumps on a 2-year basis ever. And it's in the back end of that. And the history of these things are very bad for crude oil, particularly if you have the Federal Reserve still tightening and disappointing data out of China. Those are current trends. So I'm still very bearish crude oil. I see it at the upper end of the range. I still think it's more likely to head towards 40. And right now, one key thing that's really mattering for everything and virtually all risk assets, most notably copper and crude oils, the U.S. stock market basically has to keep going just for these markets to stay stable. So that's the problem. If stock market actually drops a little bit, these assets are probably going to continue reverting last year's pumps.
So that's the trader perspective, Fernando. What do we know about supply and demand here?
Well, on the demand side, of course, Northern Hemisphere summer. Paul's driving more to the shore.
Yep.
They're driving a little bit more consumption, but it's been slightly underwhelming on the last few numbers of the EIA. In July, of course, you had the start of the Saudi Arabia, the additional cuts that they promised in the last OPEC Plus meeting. So that's probably sapping a little bit on the supply side. But when we look at the inventory figures, it hasn't changed drastically. It's really been this whole, all right, we're coming to a soft landing in the economy, which Mike is just showing that the current data is not really pointing towards that direction. But there's an expectation that the soft landing is what will really push us over the edge, and that's likely what's driving oil prices higher. That and the OPEC Plus cut, at least in the short term.
Exxon kind of missed numbers today. How do you do that if you're an energy company? I could make money as an energy company. What happened to Exxon?
They made money, and to be fair, they told you they came right in the range that they guided.
Okay.
4 weeks ago. It's just consensus a little slow to update sometimes.
Okay.
You know, analysts are a little stubborn. You wouldn't know anything about that.
Of course not.
But they still generated significant free cash flow. Not enough to cover their buybacks, but they generated enough free cash flow. The good thing is they came into the quarter with almost $33 billion in cash. The net debt to EBITDA under 0.2 times. It stayed at that level. So they can still get to that $35 billion of buybacks by the end of 2024. Of course, that will probably mean higher leverage unless Brent goes above 85.
Mike, how do you play earnings as a trader, or do you? Give us some trader insight for those at home that want to play along. I mean, when earnings season comes around, usually analysts are lowballing, right? But in this case, as Fernando points out, they haven't caught up with the forecast cut that we got out of Exxon. How do you play? Is it an opportunity earnings?
Well, the key thing to remember about energy equities versus underlying energy measures as measured by the Bloomberg Energy Commodity Index is the equities typically outperform. And that was definitely the case last year. And it's still been the case this year. The key thing is you look at the XLE, that's like the major ETF that tracks energy prices. They're up. It's almost the same thing as the S&P 500. So that's the key thing to remember. The energy equities can create more with less every day. And the actual underlying commodities are succumbing to that, which is why the price of crude oil now was first traded in about 2006. But the key thing I want to point out is this recent data you mentioned, supply and demand. I enjoyed putting in my energy outlook is this month, the latest estimates from the Department of Energy is this month in July that the U.S. is consuming about 9 million barrels a day of motor fuel, gasoline, which includes ethanol. I know Matt loves that. Compared to 2019 in July, that's 5% below. And here's another statistic I really like pointing out that really accelerated is Bloomberg New Energy Finance pointed out that global EV sales are now about 15% of new auto sales. Compared to the same period in 2019, it was 3%.
Wow.
Where's that going?
Yeah, that's crazy. And by the way, that's only going up, right? I mean, exactly. Who was it? I think I was talking to Fatih Birol of the IEA, and he said he expects it to go over 20% this year. So,
but those of us own EVs, I said, there's no way I'm going back. It's just a better way to get around.
All right. Fernando,
I'm going to go ahead and disagree with you there.
There's no replacement for displacement there, Mike. So, all right, Fernando, our good friends down in the Permian, I mean, in other shale areas in the U.S., they're pumping, aren't they?
Yeah, I mean, Chevron just broke their record 772,000 barrels a day in the second quarter. So they're trending towards that 1 million barrel a day by 2026 that they aimed. And Exxon as well, producing significant barrels there. And I think we mentioned last time, but we think the 5 largest producers in the Permian are going to account for nearly 50% of production by the end of the decade. That's Exxon, Chevron, ConocoPhillips, Pioneer, and Occidental. So they are growing. It's just not as fast as that was once hoped. You know, the dreams of us getting to 16, 18 million barrels a day are probably in the rearview mirror.
So what do we do now?
We do about 12 and a half, just under 12 and a half.
Okay, and how much do we're net exporter, right?
Yes and no. It depends because we don't have all the crudes that we need, so we import some. But yes, on a net basis.
I think I can go down to Texas, Houston, you know, raise some money from some good old boys and start putting some holes in the ground. And at $80 a barrel, I can make a lot of money.
You would.
My cost is like 40, right?
It's a 40 just on the drilling side, but then you have all the. I mean, you're not cheap.
Okay.
And you have to pay for you. You have to pay for your CFO. You have to pay taxes. So your overall fully loaded costs are higher.
Yeah, I'm gonna be a wildcat.
And then you don't get $80. You get a discount on that. And you don't only produce oil. You produce other things.
Hey, Mike, does the SPR play at all into the equation here? I mean, I know that we drained it, you know, to buy votes for the Democratic Party before the midterms, which is, you know, that's what the SPR was for.
Nice trade.
Are we going to fill it back up? I thought the idea was we were going to do that when it was low, and it was low, and we didn't.
There was no hurry to do that if you really compare it to when I was pumping gas at a gas station in 1979 as a gas jockey, and gas price went over $1. We had a price in half gallons because of the analog tanks couldn't do that. There is a massive excess of supply. If you look at liquid fuels of U.S. and Canada, around 4 million barrels a day. For those old days when U.S. was a net importer are over. So the only really reason you need the SPR now is for offsetting things like hurricanes and stuff, because we could ramp up that supply even more so if we want. I'm looking at liquid fuel production in this country is basically an all new high. Include liquid fuels because I have to include ethanol from the farm. That's almost 20 million barrels a day. Our consumption peaked about 15 years ago. So there's a very bad trend for prices, and that's the key thing about SPR. President Biden might go down as one of the best oil traders in history.
All right.
You
heard it here.
That's fascinating stuff.
Petroleum distribution engineer. That is the term.
That's what the gas jockey is?
That's right.
Were you pumping leaded gas?
Yes.
Was that leaded, Mike?
guess he's
stopped
listening.
Yeah, all right. Mike McGlone, he's back out on the pump. Mike McGlone, Fernando Valle, they cover all the energy space for Bloomberg Intelligence. They put it in perspective for us, and we appreciate that. This is Bloomberg. All right, let's get some company news right now. And Lisa Mateo.
Good morning, Paul. Ford says a price war for battery-powered vehicles has forced it to scale back on plans to ramp up its electric vehicle production. Now, the automaker said it would need another year to meet a year-end target to reach an annual production rate of 600,000 EVs. Ford now expects to see losses from EVs hit $4.5 billion this year. Bloomberg Intelligence's Kevin Tynan has more about the pricing pressure.
Something like F-150 Lightning is transacting up around $85,000, which there's probably a little bit of margin in there, but it's certainly nowhere as near on a profit contribution dollar basis that the internal combustion F-150 would be, which is selling at $65,000. So those dynamics really have to level out and turn more favorable.
Now, shares of Ford right now, they're down about 3%. And T-Mobile said it just had its second best quarter in 8 years when it comes to adding subscribers. Bloomberg's Gina Cervetti reports.
The wireless company added 760,000 mobile phone customers, blowing away its competition. T-Mobile also raised its subscriber forecast for the year as the company cashes in on its 5G lead.
Now, shares of T-Mobile, well, they're up just a fraction. And investors seem impressed with Intel's chip sales forecast, and that shows demand is recovering after a slowdown following a pandemic surge in computer purchases. And the server part of Intel's operation isn't recovering as well due to sluggishness in China and weaker than expected demand at some cloud and corporate customers. Checking in with shares right now for Intel, they are up about 5%. Those are the company stories we're following this hour. I'm Lisa Mateo, and this is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. This on a day when we have the major averages all in the green right now, adding to some of the earlier gains. Consumer sentiment at the highest since October of 2021. Chalk it up to easing inflation. The University of Michigan Sentiment Index climbing to 71.6, according to the final print. The Fed's preferred inflation gauge, we got that earlier today. Personal consumption expenditures price index, that rose 3% from a year earlier in June. That's actually the smallest increase in more than 2 years. So you throw all this in the blender, what comes out is Goldilocks mixture. Major stock averages again higher. 10 of the 11 major industries in the S&P 500. They're in the green, being led by communications, services, and consumer discretionary stock. S&P 500 right now 43 points higher, 1% higher, 4580 on the index. The Dow Jones Industrial Average up 183 points. That's up 0.5%. The Nasdaq 100, 250 points higher, rise of 1.6%. And the yields, 2-year down 5 basis points, the 10-year 2 basis points lower. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Matt and Paul.
All right, John Tucker, thank you so much. Matt Miller, Paul Sweeney here in the Bloomberg Interactive Broker Studio. We are streaming live on YouTube. Just head over there and search Bloomberg Global News. Sasan Garamani joins us. He's president, CEO, and founder of SGH Macro Advisors. He joins us live here in our Bloomberg Interactive Broker Studio. Sasan, former senior FX trader at Chemical Bank. Dude, that's going way back.
Oh, gosh, I don't even use that name anymore.
Oh, I love
call it
that
JP Morgan. You know?
No, see, I was at Chase when we hooked up with Chemical Bank, and we inherited a loan from a certain casino operator in Atlantic City, which ran into problems, and we had to do some things about there, namely taking the keys. But that brings it back.
I feel like I know who you're talking about.
Yeah. Well,
did he later become the president of the United States?
You just can't put 6 times leverage on a casino. That's the bottom line. Sasan, talk us about some of these central banks here. We've had a lot of activity, including the Bank of Japan today. I mean, when I look at the ECB, when I look at the Fed, it seems like they're saying we're pretty much done. Is that kind of your takeaway?
Yeah, I mean, we knew that we were close to the end of the cycle, so the question was always, would it take another turn of the screw, basically, to get us into the landing zone for both the Fed and the ECB. And, you know, the central banks are signaling, are reinforcing that they essentially agree with the markets, that we're near the end. I still feel that, you know, we are currently in the state of, I was thinking of using the term disinflation euphoria, but I think that kind of is a little too pejorative, but more disinflation optimism, because there is, you know, there's reason for it. But broadly speaking, I think that through the course of this whole inflation cycle, the markets and policymakers have underestimated the resilience of the economy. They sort of look through a lot of the, you know, the demand-driven components of inflation, and people look very much at sort of, you know, the subcomponents of, you know, of inflation, used cars.
I have no idea why economists ignore. It seems like ignore the demand-driven side of it.
Yeah,
I don't get why. Why is that?
Yeah, I think people want to declare victory, you know, and I think the policymakers, everybody wants this to be over.
Well, yesterday we talked with Cam Harvey at Duke, and he said, you know, that the Fed's got it all wrong. It's not 3% inflation. It's like 0.1% inflation. Like he said, the picture is completely skewed by the housing, the way they calculate housing in there. And I think a lot of people agree with him that it's much lower than the Fed expects. Are you worried that the Fed pushes us into a recession by hiking too much?
I'm not worried that the Fed pushes us into recession. I think that it will take a recession, and I don't think the Fed, the Fed, the ECB, everybody is now managing towards growth. So this is what's new here with this inflationary cycle. As we get closer to the top, they're more, you know, looking at a two-sided view, trying to balance the soft landing that everybody's talking about. And, you know, I don't want to. Policy error is, you know, maybe too easy of glib of a word to say, because I understand what they're trying to achieve here. But, you know, to the extent that spot inflationary numbers are showing a disinflationary trend, I think people really underestimate the self-reinforcing elements of inflation. I think we have, you know, I mean, I don't want to sound like, you know, oh, back in my day, but I think that you know, that the global central bank community, you know, back when they did the new framework and all that, they said inflation, we know how to deal with it when we see it. And, you know, they were kind of caught deer in the headlights. They scrambled to catch up. But I think there's still this this tendency to think that to underestimate the forces of inflationary pressures once you unleash them. For example, you know, the nominal spending. I mean, we look at in, you know, corporate profits. You look at, you have to think in nominal terms a lot here, and you see, you know, the corporate America is doing well. They're still able to pass the pricing, you know, is being passed through to the consumers. Europe is a little bit different story. We're seeing obviously more slowdown in Germany in particular.
Recession, yeah.
But I think there are two things that really stand out to me. One is that the underestimating the self-reinforcing elements of inflationary dynamics once it sets in. And the other is that I think people still, even today, underestimate the power of the fiscal impulse that was put into the system. And economists and the central bankers, they don't like to, especially the Fed, they don't like to talk about fiscal policy.
Yeah.
But we still have there's these things.
It's too big to be left out of the conversation.
It's still feeding through. It's still feeding through into the system.
Paul, this morning as I was driving to work, I was on a call with.
What are you driving?
I'm driving right now. I'm driving an Alfa Romeo Tonale. We're going to talk about that. Okay. But I was on the phone with the CEO of Maserati.
And apparently not paying tolls either.
No.
Should we ask John Tucker? John, what do you drive?
Subaru. Matt wants to jump in. A Subaru.
All right, I'm sorry, I got everybody off track. Sorry.
No, I was just Subaru is a great car. I was talking to the CEO of Maserati, Davide Grasso, and he said they still have inflation. They still feel it pretty strongly in their input costs, right? And so they're passing that along to prove your point. The Maserati Grecale Trofeo, which is a small SUV, is going for over $100,000.
Wow.
Yeah.
Yep. But no problem for Matt Miller. All right, Sasan, before you were founded SGH Macro Advisors in 2009, you made your living trading currencies here. So I got to ask you, I got the dollar down, 10% from its high back in the fall here. What's your call on the dollar here? Is there a bearish call on the dollar, or is this just a little trade down?
No, I think there's a bearish call on the dollar. I think, it might seem at odds with the notion that we still have inflation and we have more room to hike rates. But, we have to look at it, and this is always a tricky part with currencies, to have a dollar call is you got to look at what dollar yen is kind of a different animal than the euro.
Oh, my goodness. What happened yesterday?
But, they pulled it off very nicely, I think, the Bank of Japan, it's people were expecting this to be sort of a huge, explosive event for markets. We had
dollar yen still in the same range that it was, 140, right? U.S. Treasury are still under 4.
Yeah, and importantly, the JGB yields, they went up to like 56 basis points and settled in like the mid-50s. So it's not like, they lifted a 50 basis point ceiling and
it went to 100.
And it went to 100. And the reason is, and this is why I think UAIDA did a nice job on this, is that, and we've kind of been flagging this, that the tactical window for them to do this was going to be at a time when there wasn't a lot of bearish pressure on global bond markets, which we look at what's happening in the U.S. and what's happening in the ECB. It was a really nice window for them to sort of to walk in and manage it. So dollar call, I think we're close to the end of the cycle. I don't think we're at the end of the cycle. I think we still have a couple more hikes. I think we have at least one more hike left. For the Fed. And I sort of think that, looking ahead, the central banks might need to, to put another turn on the screw on tightening because...
Well, Powell said that. He said he kind of warned us about September, right?
Yeah. I mean, September, the markets have priced everything out, for the U.S. right now. And I think that the issue with September is just that it's going to be hard for them to explain or to even want to, press for a hike when the inflation numbers are most likely going to come in benign, and markets have been expecting that, and I think there's no reason.
But they can prove their point. He can say, listen, I was telling you all year, I want to get to 2%.
Yeah.
3% is not good enough.
Yeah.
Yeah.
I don't know.
I think that's the broader point is that both the ECB and the Fed, I think their current stance, I think putting aside the 2023 numbers, if you look at kind of the 2024 forecast, I think it's a little aspirational, the pace at which that they expect that, that inflation, the disinflationary trend is going to continue. When that manifests itself, I still think the ECB is going to hike in September.
That's a bummer.
Yeah.
No,
Why?
You're no fun. I'm done. I've taken a recession off the table. I'm done with rate hikes. I've got earnings troughing here. I'm set up for a ripping market. That's my call. I'm sticking with it.
One of the problems for traders has been that I think they haven't been able to square the circle with interest rate hikes versus stock market going up. It can still happen.
Yep. All right, Sasan, thank you so much. Sasan Gauramani, President, CEO, and founder of SGH Macro Advisors. We appreciate you coming in here. Right now, let's head down to Washington, D.C. Nathan Hager's got World International News.
Paul Sweeney, the top Republican in the United States Senate, is trying to put concerns about his health and age to rest. Bloomberg's Anne-Marie Hordern has more from Washington.
Senator Mitch McConnell plans to stay on as the Senate Minority Leader to lead the Republicans on the Senate side. There's been a lot of speculation and concern regarding his health. Remember, he had a concussion. He was out for a few months. He came back, and then while on camera, while speaking to reporters, having this press conference, he froze for 20 seconds.
Bloomberg's Anne-Marie Hordern reports this statement from McConnell's office, first reported by CNN, does not mention the senator's plans after this Congress. It ends in 2025. McConnell will still be serving his 7th term in the U.S. Senate. President Biden heads to Maine today. He's going to sign a couple executive orders. One would take the decision-making process on prosecuting serious military crimes away from commanders and leave it to independent military attorneys. Many women in uniform have said their sexual assault claims were not taken seriously by the chain of command. The other order will encourage companies to manufacture new inventions in the United States. He will sign that at a textile factory in Freeport, Maine. It's better than a coin flip that someone in this country is dealing with extreme weather today. Close to 200 million Americans, 60% of the country, are under some type of heat warning or flood advisory. Not cool. Even in Minnesota.
We try to just keep an eye on each other. We'll look at my colleague and say, hey, you're moving pretty slow. Why don't you go sit in the AC for 10 minutes? We love the work, but on days like this, you definitely question it a little bit.
That woman runs a tree company crew in a town in Minnesota where it's going to get up to 88 today. Heat indexes in the Northeast, including New York City, could be back to 110 for a second straight day. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Had a raft of economic data for the end of the trading week. It's raising hopes the Fed can achieve a so-called soft landing. Among other things, there's some more evidence of moderating inflation and consumer sentiment. That also rose in July to the highest level since 2021. Meanwhile, Christina Hooper at Invesco says the Fed still remains data dependent.
There is a significant amount of uncertainty about when the Fed will be done. It could already be done. It just won't communicate that. But of course, the data gives us a much better sense because, as Jay Powell said, the next 8 weeks and the data that comes out in the next 8 weeks is very important.
Right now, the 2-year yield 7 basis points lower. The 10-year, that is down 4 basis points. S&P 500 up 37 points, a rise of 0.8%. 45.75 in the index. The Dow Jones Industrial Average up 190 points. The NASDAQ 100 right now 236 points higher. That is up 1.5%. You have 9 of the 11 major industry groups in the broader index. They're higher right now. Communication services in the lead. And Microsoft, Apple also responsible for much of the point gain today. You were talking about this yesterday, kind of speculating a little, Matt. The car carrier fire near the Netherlands coast, almost 500 electric cars were on board. This is according to the operator. So that's a lot more than we previously thought.
I thought they were like 25, 26.
Yeah, this is the name of the ship is the Fremantle Highway. Still
burning?
Well, they're still having a little trouble putting it out, and that would make sense since what the lithium-ion batteries burn like. I mean, it's
crazy. It takes days to. I mean, usually we just let them burn out.
That's all you can do. I remember in chemistry class, in the same, it was magnesium. You just couldn't put it out. Right. We had a fire in the lab once, and it was just like, just get out.
Were you involved? It was just something we need to discuss.
I started it, but it was kind of an accident. So the chemistry professor is still mad at me.
That's why John took up the career of radio.
I don't remember chemistry class.
Oh, yeah.
I was in it at some point.
My lab partner became an astronaut.
Nice.
Yeah, very
You
cool.
always had the most famous college and high school roommates.
Played
and
professional
lab
football for the
partners.
Redskins, then became, and he was my chemistry lab partner, and I was just like, dude, I'm going to draft off you and do nothing. And that's how it worked out just fine. All right, John Tucker, thank you so much. We appreciate it. All right, Bloomberg Intelligence, BI-GO on your terminal. Bloomberg Intelligence is the biggest research department on Wall Street, and more importantly, I believe, the best research department on Wall Street. So we have access to all their analysts, including Matt Henriksen. He's a senior equity analyst covering medical technology. He joins us here in our Bloomberg Interactive Broker Studio. One of the things we like about our BI analysts is they often bring us companies that we never would have thought about, never would have really, think of as an investment. But here's Dexcom. DXCM is a symbol. This is a $50 billion market cap stock. Hit a 52-week high today. It's up 21%. Matt, what is Dexcom and what's going on with this stock today?
Yeah, so Dexcom makes what they're called CGMs. That's short for continuous glucose monitors. And basically, this technology is replacing what is antiquated, which is finger sticks, which is you have to prick your finger 3 or 4 times a day to get your glucose reading.
Wasn't there a company that kind of did that a little bit, Theranos or something? Do I remember that?
Yeah, that's a different story.
All right, good. All right, we'll stick with Dexcom.
Same thing though. Prick your finger, get 4 readings a day. That's antiquated. It hurts. It's a pain in the butt.
Right. It's a pain in the finger.
Yeah,
right.
exactly.
Okay.
So CGMs come in. It's on your arm or on your abdomen. It does a reading every 5 minutes. So that's 288 readings a day without pricking your finger. And you get the trends, you get the ups, the downs. It's predictive. So it says you're going to be up, you're going to be down. That's what type 1 diabetes patients need to be able to treat, the highs and the lows. So
it's amazing that it's amazing that a $54 billion company just has one kind of trick.
Yeah.
That's all they focus on?
That's all they focus on, but that's all the trick they need right now because you have 35 million diabetic patients in the U.S. alone.
And climbing, I'm assuming.
Climbing, yes. And we'll get into those type 2 patients a little bit more. But right now, they're only focusing on the type 1s and those patients that really
What's the difference, by the way, type 1, type 2?
Oh, so type 1 is more genetic, and your pancreas cannot create insulin. So you need to inject yourself with insulin to lower your blood sugar. But, the problem with taking too much insulin is that you're low blood sugar, and then you could pass out or even worse. That's why you need the CGM, or that's why you need to prick your finger.
But that's something that you inherit. That's not something you get from drinking way too much soda.
No. That's when you get the type 2, and by drinking so much soda or eating so many candy bars, your pancreas just cannot produce enough insulin anymore, and it kind of just shuts down because it's overloaded.
And that's I guess the big problem that we're looking at in terms of the climbing numbers, right?
Yes, and so when you see like the climbing numbers, it's mostly type 2, and it's mostly due to these lifestyle decisions. Of
just eating nerds all day long.
Yep, and sitting at your desk all day long.
All right, so Dexcom, this is a way to play that market. And did they have some earnings recently or something?
Yeah, so they reported last night, and their recent product, it's the 7th generation, so obviously called G7. That launched earlier this year, and that's helped boost revenue. So they beat in the quarter, and then they raised their guidance. So now they're up to $3.5 billion to $3.55 billion. That's 20 to 22% growth on a $3 billion revenue run rate. So the market liked that, and so we've seen the rally today.
All right, so in the world of kind of medical equipment, what are some of the hot areas? What are the areas that kind of get your attention?
Yeah, I mean, so the big themes in medtech right now is diabetes is one, and robotics is another one. The main company participating in robotics is Intuitive Surgical, ISRG.
Intuitive Surgical, what's the symbol?
ISRG.
Okay.
And so you're talking about a $50 billion company. This is a $100 billion market cap.
You just don't know these companies. Where have I been? All right, what do they do?
So they are creating robotic systems that help with various surgeries. It can be anything from general surgery, so hernia repair, bariatric surgery.
A robot is doing this?
Yeah, well, I mean, it's so this is where you get your kids to start playing video games.
Oh, I see. Okay.
It's controlled by a video game, or what looks like a video game controller.
Okay.
So the surgeon uses a joystick essentially to do things in extremely precise ways.
Exactly, and what basically, even when you think about a surgeon, what do they have? They have a very steady hand. But even the steadiest hand by the oh God, I would not want to.
It's a John Tucker.
Yeah.
Paul's hands are too shaky. I knew a surgeon in London. He had to knock back basically a bottle of scotch before he could do any kind of operation.
That's not good.
Yeah.
And this is the guy you went to.
Yes. He's a friend of mine.
Well, yeah. That's why you should never mix friends in work, right?
So Intuitive Surgical. I wonder if there's any AI involved. I've noticed. We've all noticed, I think, lately that every company seems to be using artificial intelligence. Are you seeing that in any of the companies that you cover?
Yeah, there's it's AI, and it's for medtech. It's specifically machine learning. So you're learning from the past procedures, whether it's surgery, whether it's knee replacements, and you're learning to see what went right, what went wrong. You're learning with these patients how the recovery is. And then you're trying to use those, and you're trying to show the doctor, hey, why don't we try this method next time? And so it's you're building this big data, machine learning aspect to try to really streamline and kind of make the surgery just more efficient.
All right, the 2 companies or 3 companies you've given us so far, they're all up 20, 30% this year. So in the medical technology, medical equipment business, is this just a play that post-pandemic, we're now going back and getting procedures done, so your companies are doing well?
Yeah, I mean, that's pretty much, you just
job.
answered it for me, yeah.
I can do his job. I can walk into Fidelity tomorrow and say, buy these stocks because people go.
But you know what, the thing though is that because of the rally this year so far, this earnings, you've had to have had a perfect report, or else the market's going to kick back. And, Intuitive Surgical, for example, they beat estimates, they raised guidance, but in their call, they made one comment that there is slower growth in bariatric surgery, which is just a small portion of their total surgeries. And the reason was that patients are trying Ozempic and other weight loss drugs before going to weight loss surgery. And so that
big competition,
big competition there.
Ozempic?
Yeah, why go under the knife if you can just give yourself a shot in the arm or wherever they get it and lose weight that way?
All right. You're gonna come back and talk to us about Ozempic, Ozempic or whatever it is. I can't imagine.
You got to get me a prescription, man.
You got to hook me up. All right, Matt. Thanks so much for joining us. Matt Hendrickson. He's a senior equity analyst covering the medtech space for Bloomberg Intelligence. And again, terminal users can find all the research at BI Go. This is Bloomberg. All right, let's get some company news right now with Lisa Mateo.
Good morning. Exxon and Chevron shares are really under pressure after posting declines in quarterly profit. Bloomberg's Abigail Doolittle reports.
It's interesting, though, to see the shares of Chevron trading lower than Exxon, given the fact that they beat both top and bottom line estimates. Exxon did beat revenue estimates, but their profit not only was it down 50% year over year, it missed slightly. So this is a margin problem. Both of these companies, or at least Exxon, is talking about the actuality of downstream or refining margin pressures.
Now checking in with shares of Exxon right now, down more than 1.5%. Shares of Chevron down nearly 1%. And the Barbie movie, it's generated nearly $500 million globally in ticket sales. And the company who makes the doll, well, they're taking notice. Mattel looking into making a sequel. CEO